Equities trading for this Tuesday morning. Here are your headlines. Jay Powell paints a picture of a patchy economic recovery, while the Fed's John Williams says don't expect any policy shift just yet. US futures trade lower. Germany pushes ahead with plans to exempt fully vaccinated people from restrictions. Meanwhile, the FDA is reportedly set to authorize the Pfizer-BioNTech vaccine for children aged 12 to 15. And the couple behind one of the world's great fortunes and philanthropic operations are to divorce. We'll discuss Bill and Melinda Gates. Good morning, everybody. Just 10 seconds then to go until the start of the European equity trading session. Let's take a look at these futures. A little bit skewed by the fact that London was closed yesterday, so FTSE futures to the upside, up by about 0.5%. Elsewhere, things looking a little bit more muted, as you can see there on DAX and CAC futures. And as we get to the start of the European equity trading session, then European equity markets just waiting to get the full picture, but the FTSE 100 is open, up by around 0.4%, so playing a little bit of catch-up from yesterday. The IBEX opens an 1/8% to the upside, and so a lot of focus on the London market and the catch-up story there, or a lot of sway being given to that perhaps by the Stoxx 600 this morning. But elsewhere, things looking a little bit more muted. So we've got the CAC 40 in Paris up by 0.2%, and the DAX up by 0.1%. So European equity markets opening broadly to the upside, of course, skewed by that reopening of the London market. Market seems to be looking through the persistent threat of the pandemic, focusing instead on the relative success of the vaccine rollouts. Joining us now is Mike Bell, JP Morgan Asset Management Global Market Strategist. And Mike, very good morning to you. I wanted to start with the really big picture, the picture for stocks, the arguments for owning stocks at this point. A lot of people concerned around valuations, of course, as we are not far from all-time highs. But you've been asking whether we're anywhere near the end of this journey to higher stocks, and you don't think so because we don't see a recession looming on the horizon. Talk us through the logic, Mike.
Yeah, so I think, and it's very simplest, if you look historically, you want to be invested in equities unless you think there's going to be a recession in the next 12 months. Now, the probability of there being a recession in the next 12 months seems extremely low to me, given that we've got huge amounts of pent-up savings in most parts of the world, that they're going to get deployed and lead to really quite a spectacular growth outlook, actually, over the next 12 to 18 months. Now, the other sort of concern that we see at the moment is around inflation and the kind of risks that that could pose. But I think, again, historically, if you look at it the next few years, given that lack of recession.
Okay, so even in the US, because of that lack of recession. So if you see interest rate rises coming in 2023, and you don't think we shouldn't worry too prematurely about the Fed's reaction function and its ability to sort of curb the enthusiasm, where do you see inflation heading then, Mike? How temporary is temporary, I suppose, I'm thinking about this morning when it comes to an inflation spike? Because many people are talking about the inflation spike, and even central banks don't deny that the inflation spike is either here or coming. What is temporary, though, when we look at inflation and that story?
I think temporary is really over the next 12 months. I think if in 12 months from now, inflation's come back down to maybe not right below target, but inflation somewhere in that sort of 2 to 2.5% range 12 months from now, then I think that we'll be looking at this as a temporary pickup, and then the Fed are not going to be having to worry about hiking rates quicker than people are currently thinking. So even if we do get above target inflation, though, and it's more persistent, right? So I think the jury's out as to exactly how temporary this pickup in inflation is going to be. Even if we end up with, say, 3% inflation for the next 3 years in a row, I still think we're in a world where it's too early to be worrying about what that means for the economy. Because yes, it means that the Fed would put interest rates up sooner than they otherwise would. But it still means, I think, that we're several years away from the point at which interest rates get to such a level that they slow the economy and actually cause a recession.
And we also know, of course, that the Fed is not just looking at that inflation story, is it, Mike? It's looking at unemployment. It's also looking beyond aggregate numbers on the US economy. And maybe this is a big departure from the past. I know that Bloomberg, we've done a lot of analysis of the recovery being experienced by different groups, by minority communities, for example, in America. How much is this set to stay the hand of the Fed? How much is this going to be something that means that the Fed is more cautious, takes its time more in this rate hiking cycle?
Well, I guess it depends on the speed of the labour market recovery. Now, I'm actually pretty optimistic on the speed of the labour market recovery, because when you look at where the job losses have been, a lot of them are in that hospitality and leisure sector, which I think is going to be the part of the economy that absolutely booms over the coming months. Because, as I say, we've got pent-up savings. People are going to want to go out and eat and see friends that they haven't seen for the last year. And so I think a lot of that employment could come back a lot quicker than it has in previous recoveries. Now, nevertheless, though, I think even if the Fed is right that we get to 3.5% unemployment by the end of 2023, then it's just talking about a world where interest rates are not going to be getting to 2%, probably until at least 2025. And that's the kind of time where you maybe start to want to worry about what it means for the economy and for equity markets. But I think not right now.
And how much of a pivot are you doing, Mike, or is it too late to pivot into some of those travel stocks? You mentioned the pent-up savings and what people are going to want to do with those. I'm looking at the reaction we're seeing after one-day closure yesterday, of course, for London markets. There's a bit of catch-up, but also factoring in the latest news flow around Europe and the intention to open up travel. IAG up 2.6%, EasyJet up by just over 2%, TUI listed in London up by more than 5%. How much of this recovery in travel is already behind us, Mike, in anticipation of it actually happening, and how much is still to play for?
There probably is some more upside on the assumption that we get back to a world where people are traveling like they used to. But I think that is the biggest question for some of those stocks, particularly some of the airlines, is even in a world where no one even has to think about COVID anymore, are people still going to do as much business class travel as they used to? Because some of the airlines, a lot of their profitability comes from selling business class flights. And in a world where corporates have learned that you can do a lot of meetings online, I think people are still going to travel, certainly for business. But is it ever going to get back to where it was pre-COVID? I think that's the big question mark still hanging over some of those airline stocks.
Yeah, interesting perspective. Thanks for flagging that point, Mike. Thank you very much. Mike Bell stays with us, JP Morgan Asset Management Global Markets Strategist. We'll hear more from Mike in a short while here on the European Market Open. Coming up shortly, though, ahead of a virtual summit between the leaders of the UK and India, we will speak to the UK International Trade Minister, that is Ranil Jayawardena. That conversation coming up next. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the European Market Open. 10 minutes into our European trading session, European stocks lifted by the fact that London was closed yesterday, and so we're seeing some outperformance there, up by 0.8%. But it isn't just that. You can see the CAC 40 also moving to the upside, up by 0.4%. So overall, we are stronger across these European equity markets. Now, the UK Prime Minister Boris Johnson is holding a virtual summit today with India's Prime Minister Modi. The two leaders are set to unveil new trade and investment deals, as well as plans for a future free trade agreement. According to government estimates, this will create 6,500 jobs and generate up to £1 billion of business in the UK. Joining us now, I'm pleased to say, is the UK International Trade Minister, Ranil Jayawardena. Very good to see you on the programme, Minister. Thanks for coming to talk to us. So what do you hope to get from this enhanced trade partnership? This isn't the full prize, the end goal. You want a free trade agreement. That hasn't been achieved yet. But what's this staging post? What do you hope to achieve from it?
Well, good morning. And this enhanced trade partnership, as agreed by the Prime Minister, does mark forward a real positive step, I think, in a strategic trading relationship with India, because we stand side by side with India as a friend and partner during what is clearly a very deeply concerning time in the fight against COVID. And we've recognized that trade has been vital in the fight against this pandemic, and it will be just as vital as we build back better. So this deal, this partnership, this roadmap into the future, as you say, secures a significant amount of trade and investment and creates something like 6,500 jobs across Britain.
When we get to the full trade agreement, and we know that Prime Ministers Modi and Johnson will be talking about this later on today, when we get to a full trade agreement, it isn't a free trade agreement, isn't one of the sticking points, and it was under Prime Minister Theresa May when she went to India to try and secure something similar. The issue of skilled migration from India will be part of this conversation. How is that something that the UK government is going to approach?
Well, we will, of course, capitalise on the fact that we now have a level playing field in our immigration system, which treats folks from India the same as folks from anywhere else in the world, which wasn't true before. We've also made significant progress on student visas, and the opportunity to do more in the future remains open to both sides. But we've got to remember that trade has to be good for both people, and an enhanced trade partnership will play a significant role in the global economy in the coming decades. It will create huge opportunities for British businesses in India as well. And so people from Britain will want to work in India, including in food and drink and life sciences. And we can see significant opportunities in education and legal services too. And that's why, though total trade between Britain and India was something like £23 billion in 2019, the last full year for which we have figures, we believe it can double by 2030. That's the significant opportunity ahead.
So do you think that there is more visibility, more consensus around a landing ground on those migration questions, Minister, than there was, for example, under Prime Minister Theresa May? Has the narrative changed? Has the story changed considerably enough to allow some common thinking and some coming together on that subject?
Well, nearly 500,000 jobs are supported through investment in each other's economies. So it, of course, makes good sense that we find ways that people can work in each other's markets as appropriate. And you will be aware that ongoing discussions take place by our Home Office in this area. So I'm not going to get drawn on the minutiae of the detail of that that work. But what is clear is that we have a shared intent now to begin negotiations on a comprehensive free trade agreement, which, as you say, is something that we should strive towards to really double down on the opportunities for British and Indian businesses and, of course, our people as we come back from COVID. We recognise that, championing those open supply chains has been crucial now, and free and fair trade will create the prosperity that both sides need as we recover from COVID.
Talking about trade with trade partners, Minister, obviously throws up the opportunity to mention other matters. What will the Prime Minister be saying to Prime Minister Narendra Modi around the latter's handling of coronavirus and the devastation that is currently bringing to India?
Well, we stand side by side with India as a friend and as a partner during what is clearly a very deeply concerning time in the fight against COVID. We've shipped more than 600 pieces of vital equipment, including oxygen concentrators and ventilators, to try and support efforts to prevent the tragic loss of life from this ghastly virus. And we continue to work very closely with the Indian government during this difficult time. We've worked to make sure that we're sending large-scale oxygen production equipment, and we are determined that Britain does everything that she can to support the international community in this global fight against this pandemic.
In terms of the European story, then, Minister, clearly your focus today is very much on this deal with India, and we've talked to you about that. Another focus for many watching, or for many in the UK and for many around Europe, will be the pace at which tourism and travel can come back, and clearly this is an import-export story as well. How much will reciprocity matter when it comes to opening up travel to the EU? We know that the EU wants to do that, but they're keen to get to some kind of reciprocal relationship.
Yeah, sure. I think we're all looking forward to be able to travel a little bit more in the months ahead. But and while we do want to restart international travel as soon as possible, it must be in a safe and sustainable way, and it's got to allow people to reunite and allow businesses to start thriving again on both sides, whilst also protecting public health. And so, we'll confirm as soon as we can if international travel can resume from the 17th of May. But, as the Transport Secretary said, we've got to have the right systems in place. We don't want to re-import cases, so we do need to do this very carefully.
Just thinking about the domestic political picture, Minister, of course, we're heading towards local and national elections in some parts of the UK this week. Is the Conservative Party reducing its expectations given the latest news lines surrounding payment for renovations at number 10 Downing Street and Greensill and other matters?
Well, the Prime Minister and other ministers have all addressed these issues at great length. And, the focus right now on the doorsteps when I'm speaking to people, I've been out across the country, actually, speaking to people both in my own patch and beyond. And they're saying, it's great that we've got the rollout of the vaccine going so well in Britain, with over 50 million doses now given to people across the country. It's great that we've got a plan now to bounce back from COVID, including the opportunity for more trade with countries around the world. We've now secured agreements with 67 countries around the world, plus the EU. That's trade covering £891 billion as measured in 2019. And so they want us now to focus on creating jobs in every part of this country. And this deal with India, of course, this enhanced trade partnership does secure 6,500 jobs across our country, which demonstrates that we're getting on with the people's priorities.
Minister, thank you very much. Thanks for joining us. UK International Trade Minister Ranil Jayawardena talking to us today about trade with India and beyond. Coming up here on the European Market Open, we discuss the bumper earnings bonanza that we are seeing. It's 18 minutes past 8 here in London. London back in business today. London rejoining the fray after being closed for a public holiday yesterday. We'll talk earnings next. This is Bloomberg.
Friday is Jobs Day on Bloomberg Television. Will the unemployment rate continue to fall, and how will markets react? The surveillance team breaks down the numbers. The April Jobs Report, Friday morning at 8:30 on Bloomberg Television and Radio.
Welcome back to the European Market Open. 21 minutes into our European trading day. European equity markets up by 0.3%. London was closed yesterday, so catching up. But elsewhere, we see the CAC 40 also moving to the upside. The Xetra DAX underperforms then, down 0.1%. We've got travel and leisure stocks moving to the upside, and you can see some of those there. These are the London listed, a few of the London listed highlights moving a little higher this morning. We also have basic resources, the mining sector, part of that commodities conversation. That is the best performing sector so far this morning here on European equity markets. So earnings are in full swing, and European companies are delivering one of the best seasons on record. It's driven a rally in the Stoxx 600, which has climbed more than 10% this year. That's on expectations of a rapid economic recovery thanks to vaccinations and continued loose fiscal and monetary policy. Mike Bell, JP Morgan Asset Management Global Market Strategist, is still with us. And Mike, how do you play European assets at this point? I guess for many months, investors have been talking to us about how Europe will catch up as the vaccine program catches up and rolls out more quickly. Is that something you're still watching? What's the narrative for you when it comes to European corporates?
I think ultimately, if you look at earnings expectations, 12-month forward earnings at the moment, by the time we get to the end of this year, 12-month forward earnings estimates should have risen by about 10% in Europe. And then by the time we get to the end of next year, 12-month forward earnings should be about 20% higher than where they are now. And that's just if calendar year consensus earnings forecasts are delivered upon. So it doesn't require any upward earnings revisions. It really just requires time to pass and the 12-month forward earnings to go from looking at April of next year to looking at end of 2023 by the time we get to the end of 2022. So I think really that as 12-month forward earnings rise, that tends to lead equities higher. So on that medium-term view, as we look ahead through to, say, the end of next year, I think European and indeed equities in most parts of the world are going to move higher, helped by that move higher in 12-month forward earnings. It's not to say that you couldn't see a little bump in the road. The period when equities tend to do best is when the business surveys go from awful to great. Now, we've seen that over the last 12 months in the US. In Europe, we've seen booming manufacturing surveys recently, but the service sector surveys have still got further upside ahead of them. So I think, Europe may be just a bit behind the US and the UK in terms of vaccine rollout, and hence what's going to happen to the service PMIs. Eventually, they'll peak out, and then you might see a period of consolidation in the market. As I say, on that medium-term view, the move higher in 12-month forward earnings expectations should continue to drive equities higher.
And does that stand up in the face of higher commodity prices, Mike? Clearly, higher commodity prices lift some businesses and are headwinds for others. So we see today basic resource stocks doing very well across Europe, and a gauge of commodities is currently at its highest since 2012. Does that continue to be something that supports equity markets here in Europe?
I think definitely. I mean, particularly for the UK market, where they've got quite high allocations to those commodity stocks, but also across markets. I'd be more concerned from an equity perspective if we thought that you were going to see significant downside for commodity prices, because obviously that would hit the energy producers and the miners. Now, I mean, look, again, short term, perhaps there is a little bit of a risk given how high we've seen some of the metals prices go, and that we're seeing the credit impulse in China looking like perhaps it's starting to peak out. But I do think that on a medium-term view, we've got demand for things like metals coming from the need to transition away from energy and towards electricity, which is going to require lots of copper and lots of the metals that go into batteries, etc. So I think that medium-term outlook for a lot of the commodity producers is pretty strong. And for the energy companies, obviously the oil price in the very long term is at risk from that ESG transition to net zero. But in the short term, I think the oil price can probably go higher as more people start flying over the coming 12 to 18 months.
Mike, thanks very much. Thanks for joining us. Mike Bell, JP Morgan Asset Management Global Market Strategist. Mike will be continuing his conversation with us on Bloomberg Radio at 9 a.m. UK time. 8:26 here in London, 9:26 if you're in Paris or Berlin. Coming up on the program, as pressure builds on India's Prime Minister to get the world's worst outbreak of COVID-19 under control, we hear from the country's former central bank governor. That conversation coming up later here on Bloomberg TV with Raghuram Rajan. This is Bloomberg.
This is odor detection, and this is because no matter how you're bound, what container you're in, you're still producing and releasing odors, and we're kind of building off of wildlife detection dogs.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European Market Open. Half an hour into Tuesday's trading session, the first of the week for London, the second of the week for other parts of Europe. The DAX down by 0.2%, a little bit better than that over in Paris, with the CAC 40 up by 0.4 and the FTSE 100 at the first trading day of the week, as I say, up by 0.75%. Let's have a look at the sector perspective then. And as I mentioned, travel and leisure stocks doing pretty well. We also have mining stocks doing pretty well this morning, and that on the back of the surge in commodity prices that we've been talking about for some time. One gauge of commodities now at its highest since 2012. Let's get a Bloomberg First Word News update. Here's Laura Wright.
Thanks, Anna. There's more easing of pandemic restrictions across New York, New Jersey and Connecticut. All-day subway services will resume on May 17th, with capacity restrictions on restaurants, theatres and stores ending on May 19th. New York Governor Andrew Cuomo described it as a major reopening of economic and social activity. The White House is backing Pfizer's move to begin exporting US-made doses of its coronavirus vaccine. The governments of Mexico and Canada said last week they expected to begin receiving the vaccine from the US. The New York Times is reporting US regulators could authorize the Pfizer-BioNTech shot for 12 to 15-year-olds as soon as this week. Bill and Melinda Gates are getting divorced after 27 years of marriage. The two say they will continue to work together on the Gates Foundation they created, which has so far given away more than $50 billion. According to Bloomberg's Billionaires Index, the pair are worth an estimated $146 billion. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you. Laura Wright here in London. Let's take a look at some of the stocks that are on the move half an hour into our trading session here in Europe. Here's Danny Berger.
One of the biggest gainers today is Pandora, the jewelry maker, earnings with a big beat. Surely what's got these shares up nearly 6% is the fact that they're giving out a dividend and buying back shares, but also within that earnings report saying that they are no longer going to use mined diamonds, some of the ethical issues that come with that, now looking at just using lab-developed diamonds. Now, one of the other biggest movers in the mid-cap space is Mediaset, the Berlusconi company, the Italian media company, ending a 5-year-long media dispute with Vivendi over a failed takeover attempt of their pay TV section. Analysts saying that this allows Mediaset now to concentrate on their internal transformation. Shareholders also voting on an extraordinary dividend there. Finally, TUI, this also vying for the top spot for biggest moving share to the upside for the Stock 600 today. It's TUI, it's EasyJet, it's IAG. It is all of those London-listed travel companies that were closed yesterday. So playing catch up with the EU allowing fully vaccinated travelers in. Now, when it comes to the macro picture, that commodity story really capturing the attention of markets, the Bloomberg Commodity Index at a 2012 high, with ISM Manufacturing Index confirming that there are price pressures for these various industries. We have earnings confirming that too, so it's not necessarily a story anymore of those high yields showing us where the inflation is coming from, but as Sebastian Gailey from Nordea put it, inflation and really the consequences of COVID are like a ripple effect in the water. Those ripples start to meet up and cause different inflationary pressures from different angles. So at the moment, it's that commodity one, but you have to wonder when the labor market in the U.S. starts to be the next inflationary pressure to hit these markets, Anna.
Yeah, that'll be interesting. Danny, thanks very much. Danny Berger with the latest on the markets. Now, the Indian Prime Minister, Narendra Modi, is resisting pressure for more lockdowns despite COVID cases surging in the country. His approach has come under fire from the country's former central bank governor, Raghuram Rajan, who said the government had become complacent after last year's first wave.
In general, there was a sense that we had endured the worst the virus could give us, and we had come through, and it was time to open up, and that complacency hurt us because as India opened up, as it became more open to big public meetings, the virus came back in a new variant and was much more devastating, and the complacency implied that it spread much faster.
So in terms of these shortages, oxygen, for example, supply issues more than availability, et cetera, all these things that have hit this country so hard all at once, many people I think are asking, like you said, what happened? But how did India get into this mess? Was it a lack of leadership? Was it just because the pandemic has blindsided so many policymakers, so many businesses, so many countries?
Well, I think there are two areas where you can say it was a lack of foresight, a lack of leadership. One is Certainly, anybody paying attention to what was happening in the rest of the world, in Brazil, for example, should have recognized the virus does come back and potentially in more virulent forms. We saw that in Europe also with the so-called British variant. So if you were careful, if you were cautious, you had to recognize that it wasn't done yet. And India had built some facilities during the first wave, which were dismantled over the course of the year. And of course, they would be very much needed at this point. The second, I think, place where one could have paid more attention is the vaccinations. It was clear that India needed a massive volume of vaccines. And unfortunately, we don't seem to have prepared for the volume of vaccines we needed to fully vaccinate our population. So I think there's a massive effort on in India from the private sector, from voluntary organizations, and also from India's diaspora. So the good news is people are engaged, people are trying their best in the face of a very, very vicious pandemic. So that's good. I think the government is getting its act together in trying to, ferret out where oxygen is, trying to bring it together in some kind of a central plan and allocate it appropriately. This is still work in progress. The army is being brought in. The Air Force is being brought in to ship things. We are in emergency mode. So the good news is we finally realized this is a full-fledged emergency and are bringing all resources to bear.
Central banks around the world, of course, have responded to the virus in their economies with, extraordinarily stimulative policy. What is the role, if any, for the Reserve Bank of India in this process?
Well, it's doing what it can. It's been as accommodative as possible, given the fact that inflation hasn't really come down and was starting to look up. So I think the Reserve Bank has been as accommodative as possible. It has helped finance the government deficit, much like other central banks across the world. It's also built up a fairly large foreign exchange reserve position, which will come in good stead as there are some doubts about the Indian economy going forward. This will at least be a measure of comfort for foreign investors.
That was Raghuram Rajan, former RBI governor and now University of Chicago Booth School of Business professor. Let's get to the climate narrative right now and give you some latest lines coming through on that front. EU benchmark carbon rising this morning in trading, and in fact carbon permits trading above 50 euros for the first time. A lot of focus on the price of carbon and the role that the price of carbon plays in pivoting towards greener economies in various parts of the world. Coming up here on the European Market Open, though, we'll take you somewhere else. Bill and Melinda Gates are going their separate ways. The couple announced their divorce on Twitter, but made no hint of what happens to their joint fortune of $146 billion. We'll get the details next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. people who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Why did you decide to become Secretary of Commerce? Because in Rhode Island, you're the 800-pound gorilla because you're the governor.
Because I wanted to be on the team that helps America build back.
How do you start your morning?
Oh, guess who won the fight in a commercial break? This black eye you've got right now looks so authentic.
You let him get in a good punch.
Wake up with Bloomberg Surveillance, weekdays on Bloomberg Television.
Welcome back to the European Market Open. 41 minutes into our trading session, which shows some real divergence. The FTSE 100 catching up by 0.6%. The DAX down 0.5%. It's the mining stocks and the travel and leisure stocks that are boosting the FTSE 100. The CAC 40 also making modest gains to the upside now, up by 0.1%. Now, away from the markets, after 27 years of marriage, Bill and Melinda Gates are going their separate ways, according to an announcement made on Twitter by Bill Gates. The couple jointly control a fortune of around $146 billion, but made no hint of their financial plans. Joining us with analysis, Danny Berger. Danny, they have one of the most influential foundations in the world. What do we know about their plans for it?
Well, they described their marriage as irretrievably broken in a filing obtained by TMZ. But besides that, really, the message that they put out both through Bill Gates on Twitter and through their spokesperson is one of continuity when it comes to their foundation, saying that no changes to their roles or the organization are planned. I mean, they work with a lot of philanthropies, a lot of different missions. So that is a message that I'm sure a lot of these firms want to hear. At the same time, both Bill and Melinda Gates are known as pragmatists, and any fracturing of the foundation, of course, would dilute its overall influence.
Yeah, and what about the other elements of their finances then? Microsoft stock, for example, what do we know about what happens to that?
So this is set to be certainly more messy, for example, than the Bezoses, where most of that wealth was wrapped up in Amazon stock. It's not the case here. Instead, most of the wealth from Bill and Melinda Gates are in Cascade Investment. That's the family office managed by one person. So how that is split is certainly a question. Bill Gates only owns about 1% of Microsoft stock, and he stepped off the board last year, so impact to Microsoft will likely be slim. Other sort of elements that you have to keep in mind here is they're getting divorced in Washington. The way that the divorce laws work there is all of the assets accrued during the marriage are to be split evenly. But Anna, at the end of the day, we might never actually find out what happens to their $146 billion net worth because they are able to file secretly, have these proceedings secretly as well.
Sad story. Thank you very much. We wish them both well. Thanks to Danny Berger for bringing us the latest. Let's get a Bloomberg Business Flash. Some of the top corporate stories we're covering here at Bloomberg. Here's Laura Wright.
Thanks, Anna. Apple's battle with the maker of Fortnite has begun in federal court. Epic Games is alleging that Apple's App Store leaves users and developers trapped in an anti-competitive marketplace. But the iPhone maker is hitting back, accusing Epic of a fundamental assault on a business model that has helped millions of developers. Robinhood is hitting back at Warren Buffett after he said the online brokerage played a part in the casino aspect of the market. In a tweet, the retail trader favorite said the old guard preferred it when investing wasn't so easy, adding that Robinhood isn't going to sit back while its users are disparaged for taking control of their financial lives. Profits at oil giant Saudi Aramco soared in the first quarter. The recovery in global oil and gas markets helped the state-owned firm maintain its dividend. It kept the quarterly payout at nearly $19 billion. Almost all of it goes to the Saudi Arabian government. The bumper results follow strong earnings from other big oil names like Shell and BP. That's the Bloomberg Business Flash. Anna.
Laura, thank you. Laura writes here in London with your business flash. Now, G7 foreign and development ministers are gathering in person for the first time in 2 years. The meeting is set to be held in London this week amid strict COVID-secure measures. That's as Europe's biggest players are moving closer to the views of President Joe Biden's administration in its standoff with China. Joining us now is Bloomberg's executive editor for government, for international government, Rosalind Matheson. Ros, good to speak to you. So what has prompted this shift, in particular around views on China from the European elements of the G7?
Well, that's right, because it is quite a turnaround just 4 months after they finally agreed, after 7 years of very long and painful negotiations, on an investment deal between the EU and China, and things have gone south very quickly since then. It seems to be some sort of perfect storm of a bunch of different things. There is a lot of upset in Europe over China's actions in its own neighborhood, its treatment of the Uyghur Muslim population in Xinjiang, its crackdown on Hong Kong, its tensions with China, a sense that it hasn't really been a particularly good actor during the pandemic in terms of sharing information on the virus and vaccines, and that even as it was negotiating this investment deal, it wasn't showing genuine progress in opening up its own economy, and it's still protecting its state-owned enterprises, and particularly in the tech sector. And so that's all led to a bit of a hardening of the thinking in capitals, including in Berlin, from what our sources are telling us, that there's a sense that they really do need to align themselves more closely to the Biden administration on that.
Yes, and you wonder whether the change in the administration over in the US has been a crucial factor in driving this rethink as well. Ros, what about Russia? Is that likely to come up then at these conversations?
You can expect it can, because both the UK Foreign Secretary and the US Secretary of State were asked yesterday about Russia going into this meeting, and they made it clear there'll be no invitation to rejoin the grouping. But what they did say is they want to find a way to have a working relationship with Russia, who they have to engage, of course, on things like Iran and North Korea. And of course, there is that prospect of a summit next month between Joe Biden and Vladimir Putin. At the same time, there's a lot of unease within the G7 nations over Russia's actions recently with Ukraine, for example, and also the imprisonment of the opposition leader in Russia, Alexei Navalny. And the US would in fact like Germany to take a harder line on Russia over the Nord Stream gas pipeline. So all of that's going to come up at the G7 this week, and quite possibly on the sidelines as well, in discussions with Germany in particular.
So China on the agenda, Russia will be part of the conversation. Of course, we're still dealing with the pandemic in many parts of the world. Ros, what else is going to be on the agenda then at this G7 meeting?
Well, as you say, it's quite a lot. We can also expect some discussion around Iran and North Korea. We've had that diplomatic flurry for almost a month now to try and get the Iranian nuclear deal back to life. There are a lot of blocks still to doing so, but there'll be a lot of people in the room this week who can have fresh discussions around that, particularly because Iran and the US won't talk directly. So the other countries have to sort of pass them notes under the table, so to speak. So there'll be discussion around that. And also North Korea, because the US is starting to formulate its policy on the regime under the Biden administration, probably a combination of sort of diplomacy and taking a hard line. So you can imagine the US will be sounding out some of its key allies this week in London about how to tackle the North Korea question under the Biden administration.
Rosalind, thanks very much. Thanks for the analysis. Rosalind Matheson, our executive editor for international government. Coming up here on the programme, the ECB seems to be tiptoeing away from targeting yields on German bonds. That's the macro view from Bloomberg MLive's Ven Ram. We'll discuss the impact on markets. We'll get his take on what we're seeing on the broad market story today, this Tuesday here in Europe. This is Bloomberg.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Welcome back to the European Market Open. We're 51 minutes into our European trading day, and things do seem to be worsening a little bit as we go through it. The CAC 40 off its highs. The FTSE 100, kind of an outlier because it was closed yesterday. Broadly speaking, we are flat across the Stock 600, but things worsening just a bit as we go through the session. As we look at US futures, which are also worsening, we see in particular US NASDAQ futures looking weak, down by 0.4% right now. And of course, it was yesterday the NASDAQ that took the edge of what was otherwise a positive session in the US. Tesla and Amazon weighing on the NASDAQ in yesterday's session. Let's think about what is driving this sentiment then. Venram joins us, Bloomberg Markets Live currency and rates strategist. And Venram, good morning. I wonder what you think is driving a sort of a move into havens a little bit this morning. So we see something taking the edge off risk assets when it comes to equities, but also a fairly solid move into the dollar. Is it what we heard from Powell that's moving things? The fact he was talking about a patchy economic recovery. What would you suggest is weighing on risk assets?
I think at the moment the dollar is being bid, Anna, because rates in the U.S. are still inching higher. I know that futures are a bit off, but if you look at the 10-year Treasury rates and pretty much the Treasury curve, there is pronounced steepening, and the dollar is broadly stronger. So I think the longer-term message from the markets is, look, whether or not they kick paper into the tall grass, it's going to come back at some point to be the front and center of discussion in the second half of the year, and that's what the markets seem to be positioning for. Anna?
I think, thinking about the European story then, Ven, and I know you've been looking at the ECB and what it's trying to do in markets at this point, and you say the ECB is tiptoeing away from targeting yields on German bonds. Where do you see evidence, and what's the implication of that then, Ven?
I think the implications are that, bond yields, we're going to see bond yields probably rise and approach zero bound for the first time in months. If we rewind back to what happened from September through January, Anna, bond yields were more or less steady around minus 0.5% to minus 0.6%. They were bobbing around in a range, doing pretty much nothing. However, in the middle of February, the ECB seems to have changed tack to focus not so much on the level of bond rates, but on the premium at which they are trading. Right now, the fair value of bonds on my model, which has an explanatory power of more than 98% of what's happening in the markets, is about 5 basis points. While, as we know, bonds are actually trading at around minus 0.2%, meaning they are trading at a premium of about 25 basis points. That premium has been pretty consistent in recent months. To me, that suggests that the ECB may, after all, be willing to let rates rise further. And that is a pronounced shift in policy, Anna.
Yeah, that's interesting because it wasn't long ago where we were seeing a lot of pushback from the ECB when they saw rates on the rise because of what was happening in the US. And thinking about the US curve, I know you've been asking a question of the day on the Markets Live blog around how far can curves steepen in the US with inflation. What's the latest thinking there?
I personally think there's plenty of scope for steepening yet, as we have just seen the first phase of the Treasury bond market so far, what we saw in the first quarter. I think the second phase may kick in during the second half when the Fed's taper will move from the back burner to the front burner, so to speak. That means there's scope for steepening, especially in some parts of the curve, for instance, the 2-5 part of the curve, which I think has the potential to widen past 100 basis points from about 65 basis points now. There is plenty of scope for steepening in that segment of the curve, Anna.
Ben, thanks very much. Thanks for joining us. Venram, Bloomberg Markets Live currency and rates strategist. Thanks for bringing us your thoughts. So we'll keep an eye on the steepness of the curve, as Venram was just ending his commentary there, talking about that. In terms of the European equity markets, then we are coming off earlier highs, just a little bit, as US futures do deteriorate just a little. You can see there the Xetra-DAX in particular on the back foot, down by 0.4%. In terms of the sectors and where we are across Europe, it's interesting to see basic resources, one of the sectors doing well. Inflation, the push higher in commodities prices, very much part of what we're talking about this week here at Bloomberg TV. So that's part of it. Travel and leisure stocks recovering as well, and the reopening of the London market after being closed yesterday, reflecting the reopening potential for travel and leisure. So that's part of it this morning. Also look at energy stocks, because energy stocks also doing well. We see BP up by more than 2%, Total up by more than 1%. We do see a slight move to the upside in oil prices, 67.75 on Brent. That's it for the European market open. Surveillance Early Edition is up next.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
Bitcoin's probably less volatile than similar-sized assets like Apple stock or even Tesla stock.
What we are trying to do is to uphold the international rules-based order that our countries have invested so much in.
We're not out of the woods yet, but I'm glad to say that we are now making real progress.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance, the early edition on this Tuesday, May the 4th. I'm Francine Lacqua in London, and here's what's coming up on today's program. Progress, but not for all. Jay Powell paints a patchy picture of the U.S. recovery, while the Fed's John Williams says the recent positive data are not sufficient for a change in course. Europe's reopening. Germany pushes ahead with plans to exempt the fully vaccinated from restrictions. Denmark says it won't use Johnson & Johnson's vaccine. And Bill and Melinda Gates announced that they're getting a divorce. A couple who jointly control a fortune of $146 billion say they will continue to work together at their foundation. Well, good morning, everyone. May the 4th be with you. The U.S., it's a joke here in the U.K. especially. The U.S. economy is making real progress, according to Jay Powell, but not for everyone. The Fed chair said that gains have been uneven following a downturn that cut hard lines of race and income. While speaking at a community college in Virginia, President Biden insisted that no recovery would be complete if some Americans were left behind, calling on big business to pay its fair share.
I'm not anti-corporate, but it's about time they start paying their fair share. It's about making a choice. You know, we have out there this year, you have 50 corporations making $40 billion that didn't pay a single penny in taxes. Not a single penny. I don't want to punish anybody, but everybody should chip in. Everybody should pay something along the road here.
Well, these comments come as confirmed coronavirus cases in the U.S. rose at the slowest pace since the start of the pandemic. Now, in New York, most capacity restrictions will be lifted with a resumption to all-day subway service. Now, let's get straight to the markets with our Danny Berger. Danny, what's the story today? I know they're very focused also on chip shortages.
Yeah, and look, I think we're at this point where the recovery genie is not going back into the bottle. Yes, we had those Powell comments about a patchy recovery, but at the same time, it is clear that these manufacturing bottlenecks are impacting the economy. We had the ISM manufacturing report in the U.S. yesterday, and I think it was really telling, not just the fact that it did weaken, but some of these comments from companies talking about inflation of prices across most, if not all, supply lines. I'm worried about getting the materials to support the company, and steel prices are crazy high. So these are the things we're hearing, not just in the survey, of course, but in earnings as well. And the reaction in markets, the ISM manufacturing report also talking about manufacturing prices at their highest since 2008, was very swift. It is a little bit different than what we saw today. So oil did move higher after that report. It's higher again today. Yesterday, it was a story of dollar weakness. Today, it's coming back with strength. And that is really one of the key parts to where the markets are trading today. At the same time, equities taking a bit of a beating. Again, what does this mean for companies? Does it mean worse inflation? Does it mean passing these prices on to consumers? But we have both futures and NASDAQ futures weaker today. That big tech sector, of course, underperforming both yesterday and today. And then this is the persistent story. This is the Bloomberg Commodity Index. You can see what it's done over the past 30 days, but at the moment, trading at its high since 2012. So that means in the European session, it's those miners, it's those material companies that are outperforming today. But as Sebastian Gailey from Nordea put it, COVID-19 has been a ripple in the pond, and all these different ripples are meeting up in terms of inflationary causes. The one today that we're focusing on, Francine, is this. It's commodities.
It certainly is. Danny, thanks so much. Danny Berger there with the very latest on commodities. And of course, a little bit later, also we'll look at the implications and the ripples that the divorce of the Gates is having through business and philanthropy. Now, joining us to talk about the markets is Jeff Yu. He's BNY Mellon Senior Strategist for EMEA Markets. Jeff, always great to speak to you. So thanks so much for coming on. When you look at the commodities and the chip shortage, what will actually drive the markets in the couple of weeks and months? Is it still the specter of inflation coming quicker than expected, or can it be something else?
I think there'll be two things for the two biggest economies, US and China. US, absolutely, it is inflation. Is this going to be healthy inflation? Well, or is this going to be, if it's only supply side driven, is it going to be stagflationary as well? So you're going to get margins under pressure due to higher input costs, but not much love elsewhere in terms of demand. So I think that is something that the Fed will have to manage. And on China, it's interesting, more and more investors, they're worried about over tightening. They're worried that there's been too much hit to the housing market in terms of regulation. Will China actually disappoint to the downside in the second half of the year? So that's going to be disinflationary. So I think these two price factors leaning against each other is going to be really interesting over the next quarters also.
So, Jeff, what does it mean in terms of where you want to go big? Is there a certain position or a portfolio that actually you like at the moment, given what you've just explained?
Well, actually, I think Europe is sort of in the sweet spot, in particular for the Eurozone, because the bar's always been high for markets to believe in European reflation. And now I think that is taking place right now. We have the reopening. We have the unlocking, announcing plan for tourism to return to Europe, for example. But crucially, the German elections, the Greens are still in front. Is that going to not only lead to greater investment within Germany, but also closer fiscal integration within Europe? That's going to be reflationary as well. And finally, if that's where the value is, if that's where your discount is, I think the flow will start to fill for Europe as well. UK to a lesser extent, but I think that's where we are going to see a sweet spot. And Euro right now, valuations are still fairly favourable.
Jeff, overall, what will it take for some of these equities to correct? Are we there yet?
I don't think we're there yet, given markets tried to shake out the Fed in March and didn't really work. So judging by Chairman Powell's comments, and also we heard from Williams as well, there is no rush to move forward. Sometimes I think many Fed members are frustrated at the pace at which markets want to push this tightening agenda. So loose financial conditions, at least you do get some wiggle room for equities. But if we have a combination of stagflation in the developed world and lower than expected growth in China, that double whammy is going to be very, very hard for equities to ignore.
When you look at dollar dynamics, I guess, we're still, again, trying to figure out what the U.S.-China relationship looks like, and actually if Europe will have to square off with the vision of Biden's administration on how to deal with China. Could we see further trade disruption like it was under Trump?
Relative to the last U.S. administration, I guess the answer is probably not. But that is a very, very low bar. Simply hoping things don't get worse. Hopefully we can actually strive for something better. But alas, and given the way relations are going right now between China and the rest of the world, probably things won't get any better right now. So I think that's more of an opportunity cost. It's a missed opportunity whereby if all the global economies can actually work together to speed up, to hasten the pace of recovery, that could be much more beneficial for risk. But alas, it's not going to happen for the time being. But on the other hand, things aren't going to get worse. And I think we can just take that as an insurance policy.
Jeff, what does it mean for dollar then? Does it go up or down from here?
So dollar, I think we are neutral for the very, very short term, but structurally we still think valuations-wise, the dollar needs to correct lower, right? So the asset allocation trade, assuming China doesn't have a softer than expected growth that I talked about just now, I think this asset allocation shift towards Asia, that will continue because that's going to be where the growth is, and that's where valuation is still favorable. Europe will benefit as well. Fed will keep real yields relatively low in the US, and as a result, I think the dollar will continue to weaken from here over the medium to longer term.
Jeff, thanks so much. Jeff Yu there of BNY Mellon stays with us now. Coming up, Bill and Melinda Gates announced their plans to separate, splitting a fortune of $146 billion. But what happens to one of the world's largest private philanthropic organizations? Well, we'll talk about that shortly. And also up next, pressure rises on Indian Prime Minister Narendra Modi to shut down the country as virus deaths rise. But in Europe, Germany also pushes ahead with plans to reopen. We discuss the uneven global recovery next. This is Bloomberg.
Ladies and gentlemen, hope you had a good weekend and bank holiday weekend. I'm going to place an order right now on Japanese yen. The price I'm looking to buy 109.360. Okay, so if you're looking to trade Japanese yen today, if you want to make a profit on Japanese yen against United States dollar pair, here is your chance. 109.360. Position opened. Okay, so we opened long position on Japanese yen. You still have time because it moved lower, so if you want, you can place in order. Stay with me, and I will guide you through throughout until the end of this trade. I'll speak to you later, guys, and stay safe.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Let's start in Mexico City, where Ray's subway track has collapsed, plunging train cars with passengers on board to the ground. At least 20 people were killed and 70 others injured. Mexico City's mayor says the accident was caused by a broken beam. The subway line that collapsed opened back in 2012. The project suffered from design problems during construction. Now, in India, Prime Minister Narendra Modi is resisting pressure to lock down the country despite the surge in virus cases and deaths. 2 weeks ago, he said states should only consider lockdowns as a last option. But now everyone from political allies to business leaders see it as the only way to stem the world's worst coronavirus outbreak. The White House is backing Pfizer's move to begin exporting US-made doses of its coronavirus vaccine. The governments of both Mexico and Canada said last week that they expect to begin receiving the vaccine from the US. The New York Times is reporting US regulators could authorize the Pfizer-BioNTech vaccine for 12 to 15-year-olds, and that's as soon as this week. And Bill and Melinda Gates are getting divorced after 27 years of marriage. The two say they will continue to work together on the Gates Foundation they both created, which has so far given away more than $50 billion. According to Bloomberg's Billionaires Index, the pair are worth an estimated $146 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, Germany is looking to loosen some of its COVID restrictions for vaccinated people. Proposed new laws could mean those who have been inoculated will no longer be subject to curfews or restrictions on socializing. Now, this comes as the EU looks to open its borders after more than a year of relative isolation. Jeff Yu of BNY Mellon is still with us. Jeff, first of all, is there a danger that we're too complacent on actually what vaccinations do, and will that lead to even two-speed recovery in Europe?
I think the two-speed recovery in Europe is something that the ECB and other policymakers are very concerned about already. So that's why the European Commission is pushing for a consistency. But if you look at the scenario analyses of the ECB, of any central bank out there, there is a fear of a new variant coming through. That vaccination does not do the entire job. So I think that's why, in terms of normalization, with very, very few exceptions, such as Norway and Canada, all central banks, they want to keep their options open. They want to see the pandemic situation almost fully under control, confirmed by science, before moving aggressively forward. So that's something that's almost always at the forefront of policymakers' expectations.
And Jeff, of course, we look at those horrific pictures from India, and our hearts really go out to the nation and a lot of the neighboring nations that could also be dealing with, some considerable variants. What does it mean for, some of investors' appetite for emerging markets when you look at how the situation has evolved, how it's been handled, and actually the delay in the vaccinations arriving?
Right. If we look at client interest and also our custodial flow data, called iFlow, it's actually fascinating because we talked about Europe doing well during the third wave, for example, as a catch-up trade. We are seeing some senses of that with India, with emerging markets as well. And clearly, the current images are devastating. But at the same time, the view is, with global coordinated effort, I mean, look at how much help is being given to India right now. Of course, more can be done. But hopefully, we've had comments along these lines already. The situation can stabilize and actually improve. So on a forward-looking basis, and perhaps people are looking for value in investing in India and some other relevant economies at this point. So I think there's kind of support coming from markets, making sure there's not a great gap out in terms of financial conditions that happens if there's a big sell-off in your markets. That is actually helpful towards the future economic recovery as well. So it's quite heartening to see that people are not doing knee-jerk reacting to what is clearly a very difficult situation.
But Jeff, how difficult, again, we're not virologists, and even the virologists have a tough time finding out exactly what variants will come from where and how we deal with it. So are we going to be in a situation where, 12, 18 months from now, we could have, even if it's not as bad a situation, a pretty bad situation when it comes to COVID, or do you think that actually now we're in a recovery phase and it'll be smooth sailing ahead?
Right, so if I can borrow the phrase, a variant discount, right? So the risk of COVID coming back in some shape or form and hitting the world economy along the lines of what we saw in March last year and earlier this year, that clearly is embedded in asset pricing. Yes, we're not seeing that much volatility and valuations are rich across different markets, but you can't prove the counterfactual. If we didn't have COVID right now, if we didn't have to worry about scarring, if we didn't have to worry about some holding back investment intentions, where would equities be? Where would global growth be? So again, that is at the forefront of policymakers' expectations again, but it's a lot of guesswork. You don't know what's going to happen in 2 years' time, 3 years' time. So again, for a company, they want to make a 5-year investment plan. You can't do that right now. So it's the foregone cost of growth that really is embedded into asset prices right now, and it's something we have to take into account.
Jeff, where do you see gold going? Is there something that you want to be invested in right now, or does it just look like you can find value elsewhere?
Right, so gold is almost a pure play still on US real yields. I've always held that view. So if US real yields are not going up, so US dollar real yields are not going up aggressively, gold, I wouldn't say find a strong bid, but perhaps downside is limited. But given at some point in the future, not immediately, but if the only direction for US real yields is higher, be that 6 months or a year down the line, then I think that's where gold will be capped. I'm more concerned right now about just the global supply shocks that you mentioned earlier. If I look at iron ore, if I look at hog prices, I look at soy, everything is going up right now. And is that just purely supply? Is that something else? It's something that, when it comes to inflation and corporate margins, we all have to deal with, in particular central banks. It makes policy making a lot tougher.
Jeff, what about chip shortages? I mean, this is one of the things that, certainly hurt the markets yesterday. I look at some of the comments from Intel saying that this could last a couple of years. Where, what are have we fully understood the ramifications of this, or could it actually get worse?
I think down to the consumer, when you have people just simply buying cars being told, sorry, you have to wait another 6 months or 12 months because I can't put the chip into your sat nav, I think that's going to start to filter through and we will start to feel it. But let's turn this into an opportunity. So we know Taiwan's situation where the manufacturing chips is very concentrated. So global supply chains are actually sort of stretched right now because of the dearth of them sources for that. But this is going to be turned into an investment opportunity amongst many different economies to push for better supply chains. I think this could actually help lift growth as well. But in the short term, like the same situation with soy and iron ore, it is going to be inflationary. But again, if it's only supply side inflationary, that's not necessarily something central banks will react to via rates.
Thank you so much for joining us. Jeff Yu there, BNY Mellon Senior Strategist for EMEA Markets. Now, coming up, Bill and Melinda Gates announced their divorce on Twitter, but made no hint of what happens to their joint fortune of $146 billion. We'll have plenty more on that shortly. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now, after 27 years of marriage, Bill and Melinda Gates are going to separate their separate ways, according to an announcement made on Twitter by Bill Gates. The couple jointly control a fortune of around $146 billion, but made no hint of their financial plans. Well, joining us now is Danny Berger. Danny, I mean, there are quite a lot of questions because it will send ripples through the business and, of course, philanthropic community. They've been one of the most influential foundations in the world. What do we know about the fate of it?
Well, irretrievably broken is how the couple described their marriage in a filing obtained by TMZ. And really, despite that strong and frankly quite sad statement, the message they've put out when it comes to the foundation is one of continuity, both in terms of that statement Bill Gates put out on his Twitter and from the spokesperson. And you have to imagine that both Bill and Melinda Gates, they're known as pragmatists, and any fracturing of the foundation would dampen its impact, would dampen the say it has in terms of the good works it does. So that at least for the time being, is really the point that it seems they're trying to drive home in all of this.
So what about their finances and Microsoft stock? Do we know what happens to that?
So we don't, and it very well could be that we never find out what happens. In Washington state, they are able to file contracts privately and keep this out of the public eye. But look, when it comes to the impact to Microsoft, there's likely not to be one. It's not like Amazon and the Bezos' divorce, where most of their net wealth was wrapped up in Microsoft. Bill Gates only owns a little bit more than 1%. Instead, most of their net wealth is in Cascade Investment, a family office. And if you look at the things that they own, it's going to be things like real estate, energy, some public stocks, but these are things that are difficult to divide. So it's going to be a little bit more of a messy allocation of finances. At the same time, Washington state, the way that divorces work there, any assets accrued as a couple during the marriage are seen to be equally divided. So there are a lot of different factors that could, again, complicate what the outcome of this divorce is, Francine.
Danny, I mean, it is actually quite incredible to think of, I guess, a more renowned couple getting divorced and having impact so wide and far. Have we had many reactions from people?
I mean, I think that a lot of times this is really being compared to just, a year ago with Jeff Bezos as well. So I think it is surprising, more or less.
Dan, thanks so much. Our Danny Berger there with the very latest on the story. Now, coming up, G7 foreign ministers meet in person in London this week. The meeting comes as European nations get closer to the U.S. position on China. We'll look ahead on the key topics on the international agenda. That's coming up shortly, and this is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Progress, but not for all. Jay Powell paints a patchy picture of the U.S. recovery, while the Fed's John Williams says the recent positive data are not sufficient for a change in course. Europe shifts back to America. We'll have a full roundup of the G7 meeting in Europe with our Rosalind Matheson. And Bill and Melinda Gates announced that they're getting a divorce. A couple who jointly control a fortune of $146 billion say they will continue to work together at the foundation. Well, good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance Early Edition. Now, on this Star Wars Day, May the 4th be with you. Foreign ministers from the world's leading economies meet in London for their first face-to-face talks in more than 2 years. Now, the G7 are expected to discuss new ways for the group to defend international rules from external threats. The UK Foreign Secretary Dominic Raab will lead the discussions in a joint press conference with the US Secretary of State, Anthony Blinken. He said that Britain and the United States are on the same page when it comes to dealing with China.
We also discussed China. I think it's fair to say we see eye to eye on the need to stand up for our values, holding Beijing to the commitments that they've made, whether it's in relation to Hong Kong under the joint declaration or wider commitments.
Well, Rob's comments signal a shift in attitude towards China this side of the Atlantic. The EU, which signed an investment agreement with Beijing back in December, also seems to be moving closer to the views of the Biden administration around China. Well, joining us now to discuss all of this is Bloomberg's executive editor for international government. She is Rosalind Matheson. Ros, great to have you on an important day like today. What seems to have prompted this shift by Europe?
Well, as you said, it is a quick shift because only back in late December, they'd finally agreed on that big investment treaty between the EU and China, and that took 7 years to get there. And so that felt like things were on a different kind of trajectory, but only in the space of 4 months, our sources in some of the key capitals are telling us there's been a significant turnaround, a hardening of views about China, and much more of an alignment with the Biden administration on how to tackle China's growing economic and strategic clout. And there's a combination of factors behind that. One seems to be China's behavior in terms of its political crackdown on Hong Kong, of course, its treatment of the Uyghur Muslim population in its own province of Xinjiang in the West, and sort of tensions with Taiwan, and a broader sense that even as this treaty was being negotiated, that China is still not showing genuine progress in opening its own economy to the world and including to European companies, and it's protecting its state-owned enterprises. So even as that treaty was being done, China's not showing the kind of goodwill that Europe is still looking for, and particularly now questions around control of things like technology and how to regulate tech companies. And that's all feeding into this feeling just in recent months that things have taken quite a turn when it comes to the perception in some of these key capitals in Europe.
Well, how will they deal with Russia, Ross? I imagine it will come up.
Well, yes, this is actually the first time, of course, that the foreign ministers are meeting in person, face-to-face, in more than 2 years. And what that enables is a bunch of sideline conversations around the meeting, aside from just seeing each other on a Zoom call. And so you can expect that Russia's definitely going to come up in multiple ways. Of course, there is that potential of a summit next month between Vladimir Putin and Joe Biden in Europe. But equally, there's a lot of concern around Russia's recent actions on Ukraine, its treatment of the opposition leader, Alexei Navalny, And of course, the US would really like Germany to take a much harder line on Russia when it comes to the Nord Stream gas pipeline from Russia into Germany. So what we can expect, of course, is a sideline chat between the US and Germany around that. Overall, there is that overarching concern as well just about Russia's behaviour. And the UK, of course, as the host, will be first in line to sort of air those concerns at the meeting starting today.
Roz, what are the other likely issues on the table?
Well, there's quite a lot on the table aside from the pandemic and trade. Of course, there's also issues around Iran and North Korea because we've been having these conversations for several weeks now to try and get the Iranian nuclear deal back to life. Of course, after the US under Donald Trump was withdrawn from it. It's complicated by the fact the US and Iran won't talk directly, but these nations that are meeting here today are essentially passing notes to either side between them, trying to work out a way to have a coordinated move that would allow that deal to be re-energized because neither side wants to blink first. So there'll be a lot of discussion around that behind the scenes. And the other thing is North Korea, because the US is starting to formulate its policy on North Korea under the Biden administration. It's probably going to be a combination of diplomacy and some harder lines. So it will be sounding out other countries here this week on that, including South Korea and Japan, which are, of course, attending the meetings.
Roz, thank you so much. Bloomberg's executive editor for international government there, Roz Matheson. And of course, we'll hear from Roz throughout the day. Now, Fidelity slashes Ant Group's valuation estimate. The Boston-based money manager has lowered the implied valuation for Jack Ma's company by half. Now, the move follows a Chinese regulatory crackdown on the fintech giant. Well, joining us with more of the details is Bloomberg's Ant Group reporter Lulu Chen. Lulu, what, first of all, are the details for Fidelity's estimate?
Well, Fidelity has lowered the implied valuation for Ant to about $144 billion at the end of February. That compares with a $295 billion value assigned to the company in August, meaning that the company essentially halved its valuation for the fintech giant. It is quite a drastic cut, but it's not the worst, given how some analysts are estimating much more severe slashes in valuation.
So, Lulu, how are the funds and investors actually looking at Ant valuation now?
The range is quite varied and quite wide. Our sources tell us that most funds that have invested in Ant are placing a valuation of $200 billion to $220 billion for the company. We've also reported that Warburg Pincus, which is one of the more famous global funds, and the company placed its valuation at 200 to 250. Those are all marked down compared with what the company was valued at in the run-up to the IPO. That said, it's still not as drastic as what Bloomberg Intelligence analysts are saying. They estimate that in the worst-case scenario, the company's valuation could fall to as low as $29 billion.
Lulu, when you look at some of the overhauls that Ant could face, how different will Ant actually look like in 24 or 38 months from now?
So there's still a lot of work that the company needs to do. Regulators have asked it to overhaul the company and change itself into a financial holding firm. That diktat has been given to most of the fintech companies in China, and so the industry sector-wide is going through this overhaul. One of the more concerning trends that is emerging is the regulators asking that Ant sever the improper linkings between Alipay and its other financial services. Now, Alipay has 1 billion users, and one of the selling points for the company has been that it could create a lot of synergy by directing all that traffic from these users into the other financial services. And that synergy is what really underpinned the lofty valuations that we saw and why analysts were willing to assign much higher premiums to the company compared with traditional financial institutions. So the future of Ant is still uncertain. That said, the company has promised that it will go public eventually.
Thank you so much, Lulu Chen there, Bloomberg's Ant Group reporter. Now, coming up, a new study from HSBC reveals that only 1/3 of investors surveyed are bullish on emerging markets over the next 3 months. We'll find out why from one of the authors of the report. That's coming up next, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
You can say it was a lack of foresight, a lack of leadership. One is certainly anybody paying attention to what was happening in the rest of the world, in Brazil, for example, should have recognized the virus does come back and potentially in more virulent forms.
Well, that was Raghuram Rajan, the former Reserve Bank of India governor, sharing his insights on India's coronavirus outbreak as it continues to worsen. The Prime Minister Narendra Modi continues to resist calls from top business figures and world leaders to lock down the country. This is a move as his government has so far avoided after the economic devastation last year. Now, India is suffering the world's worst outbreak of COVID-19 cases, with deaths hitting a record on Sunday, and new cases above 350,000 a day. It's not just India that's been impacted by new virus waves. Other developing nations such as Lagos, Nepal, and Thailand risk facing a similar crisis. Well, HSBC's fourth emerging market sentiment survey reveals that only a third of investors surveyed are now bullish on emerging market prospects over the next 3 months. Let's get more on this with Murat Olgun, HSBC Global Head of EM Research, who joins us now. Murat, first of all, thank you so much for joining us. Now, apart from the human tragedy, which of course we think about on a daily, if not hourly basis of what's happening in a lot of these emerging market economies, what does it mean for investors? Are investors worried about getting in, given they don't know how these variants and COVID develop?
Well, thank you very much for having me. I mean, as you said, the bullishness has dropped significantly to nearly a third in our latest survey, whereas it was like 3/4 of investors bullish on EM prospects in the near term when we did the survey previously in January. But it's not like they're bearish, they're just neutral. I mean, nearly half of the investors have adopted a neutral stance on emerging markets. They sit on a lot of cash, they drop their risk appetite, and it all tells us that they lack strong conviction, they lack a medium-term view, perhaps also part of the global environment. I mean, COVID is an issue, as you mentioned, but the biggest risk perception for EM at the current juncture is actually higher inflation, both globally in the US and higher rates, but also across EM. And that seems like is holding investors back at this stage.
But Murat, so what would be a good catalyst actually for investors to get into emerging markets?
It's a very good question because there's lots of cash. I mean, we've seen also huge inflows, nearly $90 billion going into EM equity and fixed income funds, based on the data we track on a weekly basis. A little bit less than $70 billion into equities and $20 billion plus into fixed income, more so into equities. They actually use that cash in primary markets, in IPOs, in issuances, corporate, sovereign, quasi-sovereign. But the secondary market performance has been weak. And to your question, what could be the catalyst to put that cash to work? They are probably looking for, better data. I mean, we're not entering, obviously, an episode where there will be huge macro data volatility because of last year's base effect. And inflation is a major worry. 77% of investors now cite they expect higher inflation across EM, and nearly half actually are worried about higher inflation and higher rates in the US as a major impediment. I would say it's probably data as it comes in. Perhaps we'll see this sort of big, spike in inflation in the US and elsewhere in the second quarter. And as it subsides, as we expect actually as a house in the second half of the year, maybe they'll be more convinced to put cash to work.
So where do you think the money flows first? Is it, again, there's politically a bit more stability in some of the Asian emerging markets and maybe some of the South Americans. How do you make that difference, and what are investors telling you?
Yeah. So in this survey, it seems like investors once again prefer Asia's stability, which was the case in the previous surveys last year. But in January, when they become very bullish, they were branching out of Asia. But now they're back to Asia. Asia still remains the most overweight across all asset classes, by the way, which is, equity, fixed income, FX, etc. We've seen some overweights that have gone up in Middle East. But the overweights have been reduced in Latin America. So it seems like the preference is Asia. The preference is still equities over fixed income in the near term. So, one might expect as cash is put to work, as investors get more comfortable with data, maybe these regions will benefit first and then the other ones will follow afterwards.
Murat, when you look at what the Fed does and the inflation, some of the inflation, I guess, concerns that sometimes makes equities and certain parts of the markets, if not panic, certainly take caution and urge. Where do you expect dollar to be, and how does that impact the emerging markets that you're looking at?
Thank you. Our house view is still, some modest depreciation of the US dollar. Our FX strategies are looking for euro dollar 123 at the end of the year. So a little bit more weakness from here as we expect, global economy to regain, sort of its poise, as the global economy recovers more in a synchronized fashion, maybe in the second half of the year, as vaccines are rolled out in the rest of the world across emerging markets. Europe gains traction. We do expect, this would probably weigh a little bit on the dollar, but not too much, nothing aggressive. I think for emerging markets, you might argue the backdrop as we project, perhaps like more range-bound US dollar. And if that's the case, I think, with this huge amount of cash and as investors really become comfortable with the inflation outlook as we expect, perhaps we can see EM performance gaining some traction.
And do you play it through equities or actually fixed income?
At the moment, it's equities. Since the beginning of the year, our core recommendation was actually EM equities over EM fixed income. There are many reasons for that. For one thing, we think the global macro backdrop is still more equity friendly. The second thing, the earnings yield across equities are still much higher than EM fixed income yields, either local or external, and the Sharpe ratios are not too different. EM equities trade at a deep discount compared to DM equities. It seems like the earnings cycle perhaps is topping out a bit in Asia. The other parts of the equity universe is looking interesting now, EMEA and Latin America. And within the equity domain, specifically commodities, especially the commodity-related stories we think are quite interesting. You might see some upward earnings revisions. And also the currencies. We've been communicating this since the beginning of the year. The commodity currencies across EM space haven't reflected the gains, the huge gains in commodity prices, in terms of trade gains, which will eventually have to filter into, trade numbers and current account numbers. So yes, equities over fixed income, but specifically the commodity space.
Thank you so much, Murat Olgun, there, HSBC Global Head of Emerging Market Research. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Apple's battle with the maker of Fortnite has begun in federal court. Epic Games is alleging that Apple's App Store leaves users and developers trapped in an anti-competitive marketplace. But the iPhone maker is hitting back, accusing Epic of a fundamental assault on a business model that has helped millions of developers. Now, Robinhood is hitting back at Warren Buffett after he said the online brokerage played a part in the casino aspect of the market. In a tweet, the retail trader favorite said the old guard preferred it when investing just wasn't so easy, adding that Robinhood isn't going to sit back while its users are disparaged from taking control of their financial lives. And profits at the oil giant Saudi Aramco soared in the first quarter. The recovery in global oil and gas markets helped the state-owned firm maintain its dividend. It kept the quarterly payout at nearly $19 billion. Almost all of it goes to the Saudi Arabian government. The bumper results follow strong earnings from other big oil names like Shell and BP. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Now, coming up, Bill and Melinda Gates announced their divorce on Twitter, but made no hint of what happens to their joint fortune of $146 billion. We'll try and have the details next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Europe is on a good track, and the one thing that has held back travel in the last 12 months is the uncertainty about transportation. Can you actually get to your destination, and can you get back without any quarantine restrictions that are imposed on a short notice? So a clear structure in place will be very, very positive for the summer season.
Well, that was Trivago's Axel Heffer speaking to Bloomberg. The chief executive of the travel booking website says a rebound in the travel sector is being held back by uncertainty around coronavirus restrictions. I certainly know a few people that are waiting to book their flights if they're allowed to travel. We'll hopefully hear that very soon. Now, Bill and Melinda Gates have announced that they're divorcing. The pair, who have overseen one of history's greatest fortunes and philanthropic organizations for decades, made the announcement last night on Twitter. They said that they will continue to work together at the foundation, but will no longer believe we can grow together as a couple in the next phases of our lives. Now, as co-founder of Microsoft, Bill Gates accrued a wealth of $146 billion controlled jointly with his wife. Well, let's discuss the implications of the separation on Microsoft and the foundation now with our wealth reporter, Ben Stupples. Ben, great to have you on the program today. They have really one of the most influential foundations in the world and with a lot of money to give away. What do we know about the fate of that foundation?
Hi there, Francine. Yes, well, right now, all we know, based on the news that only obviously broke very recently, we know that they're obviously going to continue to be involved together through the foundation that they set up together. Now, the question remains, of course, over how this $146 billion fortune is going to be divided. And I think it's worth pointing out that Bill Gates previously tried to separate his own personal fortune from issues related to fossil fuel, and that took several years. So it's sort of the question raises for me now is how long is this going to take? Because this is a very complicated fortune that has assets spanning several industries. It's very different to the divorce that we saw a few years ago with the Bezos family, which was very much related to the singular holding in Amazon.
So, Ben, what about their finance and Microsoft stock?
So actually, it's quite an interesting question there, Francine, because actually Bill Gates left the Microsoft board last year. So we actually don't know right now how specifically how much Bill Gates has in Microsoft. And actually, Bill Gates' fortune in Microsoft is only about 20% now. His stake in Microsoft, the latest that we know, he makes up only about 20% of his overall fortune. So what he's done over the years, very different to, say, Mr. Jeff Bezos. What Bill Gates has done over the years is plow the proceeds of Microsoft into his family office, his personal investment firm called Cascade, along with the Bill and Melinda Gates Foundation that they've given about $50 billion worth over the past decade at least. So actually, the Microsoft stake is far smaller here. Actually, it's the family office and the foundation that make up the bulk of their fortune right now.
Ben, thank you so much. Our wealth reporter there, Ben Stupples, of course, will continue watching Bill and Melinda Gates, and maybe we'll have a little bit more news about what happens to the foundation, what happens to some of the stock options in the couple of hours to come. Now, this is what I'm looking at in European stocks. They're definitely drifting. A lot of important news on tech and also on chip shortage. This is what drove markets lower yesterday. Still continuing to watch, of course, the chip shortage, with Ford in Europe saying that actually this may last a little bit longer than expected. It's a similar situation of what we heard from the Intel chief executive. Bloomberg Surveillance Early Edition continues in the next hour. Kaylee Lyons, Matt Miller joined me out of New York and Berlin. This is Bloomberg.
Renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and deaths. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
Why did you decide to become Secretary of Commerce? Because in Rhode Island, you're the 800-pound gorilla because you're the governor.
Because I wanted to be on the team that helps America build back.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
India is in clear need of international assistance, as will other countries be quite soon, if not, now.
What we're seeing in India is, the health system just simply cannot cope with the numbers.
Anybody paying attention to what was happening in the rest of the world, in Brazil, for example, should have recognized the virus does come back and potentially in more virulent forms.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kaylee Lyons.
Well, good morning from London, Berlin, and New York on this Tuesday, May the 4th. And good morning, especially to all those Star Wars fans out there. Our top stories today. What a drag tech shares are holding back markets in Europe and the U.S., among them big names like Amazon and Infineon. Choosing sides, ties between the EU and China are quickly getting worse. Europe is moving toward President Biden's position when it comes to Beijing. And billionaire breakup, one of the world's biggest fortunes, is at stake as Bill and Melinda Gates plan to divorce. Now, a lot of the focus on the markets is also what we heard from the Fed chair and also John Williams. Kaylee, I know that's playing out in the markets. And of course, we look at technology with chip shortages. What else are you seeing?
Yeah, there's definitely a lot of factors at play here, Francine. I would note that in the Asian session, we did still have some markets closed for holidays, including Japan and China, but others were open and trading, and it was a bit of a mixed picture. The Hang Seng was higher by about 0.7%, but Taiwan stocks under pressure. And I would note the Sensex in India actually has flipped into negative territory now after gaining earlier. We, of course, still have the ongoing crisis in that country, and as a result, the Indian rupee is also giving back some of its gains against the dollar, though it is still fractionally stronger. The Japanese yen, though, much weaker against the dollar, down about 0.3% to 109.42. As far as what the picture looks like in Europe, it is a bit mixed. You did have stocks mostly higher earlier, but now the DAX is a big underperformer in Germany. The stock 600 right now is essentially flat. I would note, though, that, of course, the UK is back from the holiday, as you are with us today, Francine, and so they're playing a bit of catch-up to the gains we saw on the continent yesterday. The FTSE 100 up about 0.6%. In the German bond market, we did see 10-year German bond yields break above 17 basis points yesterday, then gave that back. And once again this morning, we're trading right around negative 20 basis points on the 10-year. While the euro is weaker against the dollar by about 0.5%, there is some massive dollar strength this morning. Euro dollar sitting at 120.01, right there at that 120 level. As far as what the picture looks like here in the U.S., we do look set for a softer open. S&P 500 E-minis down about 8 points. We are seeing yields ticking higher by around 2 basis points on the 10-year to 1.615%. As I said, broadly stronger dollar today. The Bloomberg Dollar Spot Index up about 0.4%. And I just have to note the Bloomberg Commodity Index, Matt, higher for the 11th day in 12, right around the highest since 2018. That commodity rally just keeps rolling on, Matt.
Yeah, we absolutely have to keep focus on that. I know Dan Curtis prepared a special chart for us today just to show how far the commodities rally has run. Even when you put it up against inflation, normally it tracks quite well, but it's really running quite far ahead of inflation at the moment. Let's take a look at what's going on today. It is day 2 of the G7 Foreign and Development Ministers meeting in London. Francine has pointed out we're really focused on trade, and the good news is we're going to get some trade data out. The balanced data comes out at 8:30. Tonight at midnight is the deadline for Israel's Benjamin Netanyahu to form a government, so definitely watch for headlines out of Israel throughout the day. We're also going to get earnings from Pfizer as well as earnings from CVS. So earnings season isn't over yet, but Fran, so far it's pretty amazing. S&P 500 companies that have reported almost 90% have beat the street's estimates. And typically, you know, they beat 60 to 70%, but 90% is an amazing figure, especially considering analysts have moved their estimates up into the quarter. So they're beating a higher bar.
Yeah, it is pretty amazing. But then you speak to a lot of course, investors, Matt, and they say, look, if you're not beating when, you know, at a time where actually the recovery is kind of roaring, ready to go, and people are getting inoculated because of COVID-19, then it'd be tougher to find another period where actually earnings do so well. Now, onto politics, and foreign ministers from the world's leading economies are meeting in London today for their first face-to-face talks in more than 2 years. It comes amid a range of geopolitical tensions. In a joint news conference ahead of the meeting, the UK Foreign Secretary Dominic Raab and the US Secretary of State Anthony Blinken pushed back against what they called Chinese and Russian violations of the global order.
What we are trying to do is to uphold the international rules-based order that our countries have invested so much in. I think the challenge for us is to demonstrate in very concrete ways that we can deliver for our citizens.
Meanwhile, relations between the EU and China have soured following the landmark investment deal reached in December. Well, joining us for more is Bloomberg Executive Editor for International Government, Rosalind Matheson. Ros, first of all, it's amazing to see the turnaround and a lot of EU countries following what the Biden administration wants to do with China. And how tricky will it be to talk about Russia?
Well, yes, it comes as we see that hardening of the broader European view on China, despite that investment treaty that was reached in December, and that's because of rising concern over China's actions in terms of its crackdown on Hong Kong and its treatment of the Uyghur population in Xinjiang, in a sense that China hasn't been a particularly good actor during the pandemic. That's even as it negotiated this investment deal, it's still not showing genuine progress in opening its economy. So some collective factors at play, and of course the concern about China more broadly will feed into the G7 meeting today, and Beijing has in fact accused the UK of trying to turn the G7 into an anti-China bloc. You saw that language from both the UK and the US around what they call agile clusters of like-minded nations, which is code really for China as well as Russia, which will come up as part of these discussions as well. But at the same time, we've heard some concerns from other G7 members, including Japan, who say they're wary about being pulled into an anti-China bloc, and they want the G7 to sort of remain focused on global issues, including the pandemic and climate change.
All right, excellent insight there from Ros Matheson. She is Bloomberg's executive editor for international government. Now, after 27 years of marriage, Bill and Melinda Gates are going their separate ways. That's according to an announcement made on Twitter by the two. The couple jointly controls a fortune of around $146 billion, but made no hint of their financial plans going forward. For more, Bloomberg's Danny Berger joins us. So, Danny, it is one of the world's most influential foundations, the Bill and Melinda Gates Foundation, that the two run jointly. It holds a ton of Microsoft stock, and they're going to continue to run that together, they say. But of course, there's a ton of money outside of the foundation as well, the world's fourth biggest fortune.
Yeah, definitely. Look, they've said very clearly continuity is the message they're pushing across when it comes to their foundation, as you said. But in terms of splitting their fortune, that's a lot more complicated and messy. I mean, not only is it massive, $146 billion, but a lot of it is tied up in more liquid assets. Most of their wealth is in a family office, and it's going to be things like real estate, energy, hospitality. So that's more difficult to disentangle. Now, when it comes to Microsoft stock, Bill Gates personally owns only about 1% of overall shares of Microsoft. As you say, he's been shifting a lot of it into his foundation. So this isn't a scenario where it's going to have that much of an impact on the company and on the company's shares itself. This is a much different divorce than that of 2 years ago between the Bezos family, when it was mostly just a single stock that's where their wealth sat.
Yeah, very fair point. Bloomberg's Danny Berger, thank you so much. Still could be quite the complicated division of wealth there. Now let's take a look at some of the stocks moving in pre-market trading in the U.S. It was the vaccine makers that were really the outsized movers in the Monday session, and they are on the move once again on this Tuesday morning. BioNTech, which is Pfizer's vaccine partner, rallied 10% to a record yesterday and is adding to those gains this morning. Shares up a little more than 2%. CureVac is up by 1.4%. Moderna up by about 0.5%. The company yesterday committed to supplying 500 million vaccines to COVAX, which of course is helping to distribute those shots in developing countries. We're going to speak with the company's chairman later this hour. The one exception yesterday with the vaccine makers was Novavax. It sank 18%, the most since March 2020, as there's still no update on its vaccine trial results. Those had been expected at some point in April, and of course it is now May the 4th. Though those shares are rebounding just a touch in early hours, higher by about 0.2%, Francine.
Yeah, so much to talk about today. Thank you, Kaylee. Now, coming up, we speak with Wei Li, BlackRock Investment Institute Global Chief Investment Strategist. And then, as Kaylee was saying a little bit later today, actually in about half an hour from now, global vaccination effort, we speak with Noubar Afeyan, the Moderna co-founder and chairman, about COVAX. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
A big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacroix in London and Kaylee Lines in New York. Now, Kaylee was mentioning earlier that we have to keep an eye on the Bloomberg Commodities Index because the outperformance has been pretty spectacular. We've got a chart here that Dan Curtis put together, and I'll tell you for the viewers who are listening on radio, what it shows is that the Bloomberg Commodities Index, which typically tracks U.S. CPI going back to the early 90s, has shot up ahead of CPI. So if you're seeing inflation in terms of the headline number at 2.6%, you're seeing commodities rise almost 6%, and that discrepancy has to be resolved in some way. Let's get to Wei Li. She's Global Chief Investment Strategist at BlackRock Investment Institute. Wei, you do expect inflation, or you see inflation being mispriced by markets right now in the near term and the medium term. What should investors do about that?
Well, right now in the near term, there's a lot of uncertainty because the reopening dynamics, which is very different from a typical recovery, will bring supply demand back online in very unpredictable terms. So I would say that in the near term, yes, we do expect inflation to overshoot Fed's targets, but there's a huge amount of uncertainty in terms of the persistence of that overshoot. In the medium term, however, our conviction is higher for inflation to kind of gradually come through. And here we see inflation in the medium term, 5 to 10 years, being underappreciated by markets because as supply chain moves from being cost efficient to focusing on resilience, that would push up inflation, production cost, and pushing up inflation expectation. And at the same time, thinking about the high debt levels that we have, the cost of kind of rate rising in response to inflation going higher, and what that means for debt servicing is just too high for us to feel quite confident that rates are not going to rise significantly in response to inflation rising fast because of the consideration around kind of debt servicing side of things. So all of that, putting them together, means that we think medium-term inflation is underappreciated.
Wait, how much do you worry about chip shortage? How much do you worry about commodities? Away from the inflation, I know everything's linked, but away from that, is there anything idiosyncratic in the market where that could actually lead to a correction?
Well, the semiconductor shortage is a big focus. You see that coming through during the earnings season, company talking about it as well. But what we are seeing at the same time is that, yes, kind of the drag from semiconductor shortage is there. But at the same time, you're seeing that being offset and more than offset by the very, very powerful restart dynamics. So we may not actually see too much of a dent because of this very powerful restart that is happening right now. And at the same same time, we're starting to see kind of the reaction mechanism kicking in. If you look at kind of South Korea, production coming back up, and also you see Intel talking about greater production, focusing around that as well. So you do see kind of the reaction mechanism in response to the shortage kicking in with a bit of a lag, but that is happening as well. And to your point, Fran, you talked about kind of the commodity prices going higher. That is in response to two forces. Number one is this reopening dynamics in the near term. Number two is this longer term kind of the green transition, what it means for certain metals within the commodity space.
Wait, Matt also had a great, chart looking at some of the earnings that say, it seems like we're priced to perfection right now, so earnings beat expectations by quite a while, but what comes after in the quarters to come?
Yes, earnings, the current season is on track to be perhaps the strongest season on record in terms of beats. It is stronger than Q4, which was already quite strong. But when we look at kind of potentially year-on-year growth, earnings growth numbers over 100%, you have to question this backwork kind of looking data, how much meaning you want to assign to that, especially given the strong base effect and the very low starting point that we're comparing this quarter to. So for this earnings season, we're also paying a lot of attention to company guidance and also kind of their rhetoric around margin. That is more forward-looking. We pay attention to that, and that lends itself to more selectivity on the sector front.
Right. It's all about the second derivative, right, Wei, and the rate of change potentially slowing down as we move forward. How do you position for that kind of world?
What we're seeing right now, exactly to your point, yes, second derivative is what markets are focusing on, is that we have entered peak growth acceleration in the US. And with a bit of a lag, maybe 2 months or so, we will enter peak acceleration in Europe. And with a longer lag, we'll see kind of greater acceleration in emerging markets in the rest of the world. So we are seeing this kind of US exceptionalism that started out 2021, broadening out as we go to kind of the second half of the year. And in terms of asset allocation, it would mean that we want to kind of think about within the US equity market, parts of the market that are geared to the international recovery, global recovery story, and more broadly thinking about kind of in the global equity space that would benefit as the baton of growth driver shifts, and specifically in Europe, for example. We have upgraded European equities from underweight to neutral earlier on this year, and now they stand to continue to perform because growth acceleration starts to pick up and vaccine rate starts to improve as well. So really kind of thinking about the growth driver broadening out and what that means for asset allocation.
Wei, thanks so much, Wei Li, their Global Chief Investment Strategist at BlackRock Investment Institute. Now, today, Bloomberg is also hosting its annual Wealth Summit online. Speakers include the chief executives of Rockefeller Capital Management and Betterment. The event starts at 9 a.m. in New York, 2 p.m. in London. We'll have a full lineup, and you can, of course, go on our website and register as well to attend as a participant. This is Bloomberg.
our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance, early edition. I'm Francine Lackman, London, Matt Miller in Berlin, Kaylee Lyons in New York. Now let's get straight to the Bloomberg First Word News. And in India, the Prime Minister Narendra Modi is fighting pressure to lock down the country to control the world's worst coronavirus outbreak. Today, India reported more than 357,000 new infections to cross a 20 million case level. Still, some experts say that a lockdown would be disastrous for the poor. Modi's government has left it up to the states to decide on local lockdowns. In Mexico City, a raised subway track collapsed, plunging train cars with passengers aboard to the ground. Well, at least 20 people were killed and about 70 others were injured. The accident is blamed on a broken beam. The subway line that collapsed opened in 2012. The project suffered from design problems during construction. And Saudi Aramco's profit soared in the first quarter after a recovery in global oil and gas markets. That allowed the world's largest energy firm to keep its quarterly dividend. Almost all of that goes to the Saudi government. The payout is a vital source of cash for the kingdom. And Fidelity has cut its valuation of China's Ant Group in half after the regulatory crackdown. The Boston-based money manager has lowered the implied valuation for Ant to about $144 billion. Now, that compared with a $295 billion valuation in August. The future of Jack Ma's company has been shrouded in uncertainty, and regulators are sorting through details of a fintech industry overhaul. I know we're all looking really at some of these valuations. Over in China, we look at Ant, we look at some of the others as well. Alibaba, I know, has that at the forefront. And then you have this geopolitical concern also with the G7. And it seems that Europe is now going behind the Biden administration. If not a trade war, Matt, certainly being a little bit more combative towards China.
Yeah, well, I mean, if we were in a trade war before, I don't see how we ever got out. In terms of the Ant Group valuation, I think it's pretty stunning. If you think about it, now Ant Group, according to Fidelity, is worth less than Bill and Melinda Gates, and that's before you add the foundation. So on the one hand, this maybe shows the shrinking size of Ant Group. On the other hand, it shows just how large and important the fortune of Bill and Melinda Gates is.
Matt finding a creative way to bring this back to Bill and Melinda Gates. But to your point, Matt, our own analysts here at Bloomberg Intelligence have estimated that in the worst case scenario for Ant, the valuation could actually fall to $29 billion, because if this regulatory clampdown really accelerates, it could mean a serious cut to the company's revenue and profit. So this could get a whole lot worse for Ant before it gets better, Francine.
Yeah, what I find amazing is actually the regulatory crackdown is on concerns we understand from the Chinese government or Chinese authorities that actually they have a lot of data that they don't share and they're just becoming too big. I wonder whether some of those conversations maybe also need to be happening in the U.S. or elsewhere.
Yeah, they definitely are. And of course, a lot of these tech companies are listed in the U.S. The likes of Tencent, Alibaba, they all have ADRs. And so this does impact the U.S. market as well, Francine.
Now, up next, Grace Peters, JP Morgan Private Bank, EMEA Head of Investment Strategy. We'll ask her about some of the tech companies. We'll ask her about equities in general. This is Bloomberg.
One of the interesting features about this illness is that if you look at it, the people who develop these long-haul symptoms are often not the individuals who are hospitalized and were sick and on a ventilator and stuff like that. These are individuals who actually, most often, they never went to the hospital. They had a relatively mild illness in the acute phase, and they recovered from it. If you were in the hospital, it means you probably mounted a very strong immune response, okay? You recovered from the illness, you probably got rid of the virus. If you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, oh, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of your life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is going to touch.
Friday is Jobs Day on Bloomberg Television. Will the unemployment rate continue to fall, and how will markets react? The surveillance team breaks down the numbers. The April Jobs Report, Friday morning at 8:30 on Bloomberg Television and Radio.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Francine Lachlan, London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, there's quite a lot going on in the markets, Matt, but it's a little bit bitty. So we're looking at chip shortage, we're looking at commodities. I know we're also trying to figure out what happens to the fortunes of Bill and Melinda Gates.
Yeah, and we're kind of hovering also at these high levels. I noticed earlier that the S&P 500 really hasn't moved much. If you look at weekly change in terms of the price there, it's been up and down. We had volatility and then obviously up since March of last year. But for the past few weeks, it's just been holding steady into earnings season. So we know the market ran up into earnings season. We know companies did quite well. But the question is, where do we go from here?
Yep. Yeah, and then, Kaylee, we also had a number, so that's the million-dollar question, the gazillion-dollar question. Then we also had a number of Fed officials kind of weighing in on what type of recovery we'll get in the U.S.
Yeah, Jerome Powell yesterday saying the recovery could be very uneven. But to your point, Matt, it was interesting. I was looking at April, which was a strong month for the S&P 500, up the better part of 6%. 5% of that gain came between April 1st and 15th, and then we only gained 1% in the back half of the month as earnings season rolled out because we aren't seeing rewards for beats, so it isn't really providing that much of an upside catalyst. Where that leaves us in today's session is softer on both sides of the Atlantic. Actually, the older that the session grows in Europe, the lower it gets. The Stock 600 was in positive territory earlier. Now it is down by the better part of 0.1%. Here in the U.S., we're down about 7 points on S&P E-mini futures. Futures lower across the board, including for the NASDAQ 100. And what's interesting to me today is the FX story. It is a broadly stronger dollar. It probably is more dollar strength than euro weakness playing into euro dollar today. It's sitting right at 120, actually broke below that level earlier for the first time since April 22nd. So definitely interesting dynamics to keep an eye on there. And then, of course, I have to talk about digital currencies as well, not Bitcoin that has my attention this week. Ether, another record high right now, sitting above $3,300. As for some movers in pre-market trading, Matt, would you like to add something here?
Well, no, I was just saying that's one to watch. I mean, I've got my eye on Ether. It's up 1,500% in the last 12 months, and it's taking market share away from Bitcoin. Please continue.
Okay, thank you for that, Matt. Very, very valuable context. I will talk more about Ether and cryptocurrencies, of course, all throughout the week here on Bloomberg Surveillance Early Edition. But as for some stocks moving in pre-market trading, I did want to point out ON Semiconductor Corp. It's interesting. It actually reported earnings yesterday. The outlook beat expectations, and the stock fell on the back of that. But today, investors seem to be changing their minds, with the stock up 6% in early hours. CVS Health has not reported yet. That is on deck later this morning, but they could get a boost from the COVID vaccination program, and shares are higher by 2.3% in anticipation of that. Mosaic, the fertilizer maker, though, missed on its earnings report. It's down the better part of 6%. And then Diamondback Energy selling some of its assets in the Bakken shale basin to Oasis, a shale driller, and that stock down 2.5%. Investors don't seem to like that $745 million cash deal, Matt.
All right, Kaylee, thanks very much for that. Look at the pre-market movers in the U.S. What I've got is a look at European stocks. You heard Wei Li from BlackRock at the top of the program mention this. Everyone has seen the power of the U.S. economy. Everyone has seen the beats on earnings, and now they're looking for that recovery to move into other regions. Well, if you look at ETFs and inflows, you can see that we had, in terms of the Vanguard FTSE Europe ETF, the biggest inflows since back in November of 2019. So investors are really piling in to European stocks, and you wonder if this rally, or this weight, I should say, will add to a rally in markets that also have kind of calmed down a little bit since earnings season began. We're just about, Fran, halfway through earnings season in Europe, and European companies, only 75 have beaten the street's expectations compared to 90% in the U.S., which either means that analysts are better at forecasting earnings for European companies, or that the performance just hasn't been as mind-blowingly strong as it has in America.
Yeah, and I wonder whether you see value now in Europe or not because of that. So let's get Grace Peters, EMEA Head of Investment Strategy at JP Morgan Private Bank, to weigh in on that. So Grace, I mean, you know, the figures are earnings in Europe, 75% of companies beating estimates. In general, this earnings season has been pretty extraordinary. What does it mean for you know, what you want to buy into now?
Morning. Thank you for having me on the show. No, this has been undoubtedly an exceptional earnings season. And let's not forget the context of this is that consensus forecasts coming into this reporting season have been consistently revised up. So the bar is exceptionally high. So when we talk about that high level of beats in the US and indeed in Europe, both exceptional relative to history, but also that shorter term backdrop as well. But let's not also forget that those beats are not getting rewarded in the same way that they have been in the past. And that, to me, speaks of a degree of investor fatigue. And I think fatigue is the right word, because undoubtedly when we see these beats coming through, our conviction in the upgrade potential for 2021 and the 2022 earnings cycle is only enhanced. We think that consensus expectations for corporate profits are going to rise this year and in the outer year. But fatigue just means that when we're thinking about, you know, the next few weeks and where the market goes over that period, we start to see a wall of worry coming into the market. Worry that earnings aren't following through and you aren't getting those positive share price reactions. Worry that in the US there's increasing talk of corporate tax increases that could put some downward pressure on those earnings expectations. And of course, whilst we've been in a period of consolidation for US Treasury yields, ultimately we do think that the direction of travel for Treasury yields is going to be higher, up towards 2%, if not beyond, by the first quarter of next year. And so as we think over the summer, what could the catalyst be there for? We're looking there for the talk of Fed ultimately introducing the concept of tapering into its language. So when you put all of that together, we call it the wall of worry. We do fear that equities could see a period of consolidation that extends over the summer months, but we would undoubtedly be buying into any dip if it does arise. And when we think about what to buy, we would advocate for a strong barbell between cyclicality, companies that do well in an improving business cycle and that are highly correlated to those rising bond yields, but also megatrends, area of secular growth in the global economy, like digital transformation and sustainability.
Grace, how will or how would Biden's planned tax changes hinder earnings growth in the U.S.?
Yeah, if you just do a sort of a mathematical calculation based on what's been proposed, you could see up to a $9 per share hit to S&P earnings. That obviously doesn't take into account the offset of greater spending, or indeed the idea that not all of what's been proposed may eventually get through. Our base case is that you will see some of the tax increases ultimately get passed, therefore that you could see about $5 downward pressure to S&P earnings, but that would for the most part be offset by higher spending, infrastructure spending, and therefore the net impact is not going to be too much. There is, of course, a bull case as well, that actually the fiscal multiplier and the impact of that spending means that there's a net upgrade to S&P earnings. And as I mentioned, everything we've learnt through this current reporting season, where we're just over 50% of the way through, indicates to us that the health of the US corporate is extremely good, which in itself puts upward pressure to S&P earnings and indeed to Stock 600 earnings. So we don't think that there is need to be overly pessimistic. Quite the opposite. We expect, towards the end of the year to see consensus upgrades to earnings and therefore price targets. But I think it just speaks to a tussle in the market over the summer as many of these issues get debated and as the forecasts work their way through.
Grace, thank you so much. Grace Peters there, EMEA Head of Investment Strategy at JP Morgan Private Bank. Now, coming up, Moderna's latest pledge for the global vaccination effort. We'll be speaking with Noubar Afeyan, Moderna co-founder and chairman. That's coming up next. We'll talk COVAX. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
The experience from countries that have rolled out the vaccines much more successfully than others, namely the UK, US, and Israel, is that it has dramatically reduced the rates of severe infections, hospitalization, and death. And what we're seeing in India is, the health system just simply cannot cope with the numbers. And so we must do everything we can to reduce the number of infections, particularly severe infections, which many of these vaccines have shown to be highly successful at.
Well, that was a World Health Organization Science Council member speaking to Bloomberg. Now, as the crisis worsens in India, pressure is growing on the global vaccination effort. Moderna has agreed to provide as many as 500 million doses of its COVID-19 shots to the Global Access Program, known as COVAX, but only a small fraction of the shipments are due to arrive this year. Well, joining us now is Noubar Afeyan. He's co-founder and chairman at Moderna. Thank you so much, Noubar Afeyan, for joining us today. First of all, congratulations on this tremendous effort. A lot of people, though, especially when you look at the pictures coming from India, say, could this not be done sooner? A lot of the shipments are into 2022. Can we get it done quicker?
Well, first of all, thanks for having me. We have been working for several months to establish this agreement and also to obtain WHO emergency use license, which we did last Friday. And the discussions have led to the announcement of 34 million doses being available later this year. It's really a question of our supply obligations throughout the world and our production capacity. And we're ramping up our production capacity as quickly as we can. We're producing roughly 1 billion doses this year at a maximum. But next year, we also announced we'll be increasing to 3 billion. So we are working as a manufacturer absolutely as rapidly as we can, as are others. Look, the reality is that there's a number of countries that have also sourced the vaccine, and we hope, together with our supply, some of the countries as well will consider what their needs are so that we can get as many doses to the rest of the world as we can.
What can you tell us about pricing?
We have used a tiered pricing system with this being at the absolute lowest price. It's been negotiated. There's a transparent way in which we've gone about it with the various entities, countries that we deal with, as well as COVAX. And so we haven't said much more than that, only to say that we certainly take into account the purpose of the COVAX facility, particularly as it gets to lowest income countries, the 92 Gavi countries. We're very, very pleased to be able to tap into that and bring our technology, our capability to bear.
How worried are you about new variants circulating that have not been identified because a lot of countries have not been vaccinated yet?
We are worried about that as we were about the virus last year, in the sense that there's an element of the unknown. Now we know a lot more about the parent strain that we were going after. As you know, we have begun human trials very rapidly on a variant vaccine against the South African strain, as well as a booster for the original vaccine, and in fact also a combination. And uniquely, Moderna has shown data in animal models, and we hope soon to have human data showing efficacy for the variants. But then, as you say, variants are beginning to spring up with yet different properties, and we're going to have to stay vigilant, potentially developing yet more boosters. And we hope to keep this at a minimal challenge in terms of how many different approaches we need to have. But at the end of the day, the virus is doing its own thing, and we need to be able to stay ahead of it.
Will you be able to maintain production goals for next year? Are we still going to see, 3 billion shots produced by Moderna next year?
Yes, we increased our forecast because of significant investment that we're making as we speak ahead of that to 3 billion doses. I'll also say that we're actively testing doses that are lower than the original vaccine that we went as fast as we could last year to produce. So to the extent that we can get the vaccine, which today is at 100 micrograms, to show effectiveness at even 50, of course, that will instantaneously double our output of doses as well. So we're doing everything we can, recognizing the need far, far outstrips what we had anticipated, especially given the alternative vaccines that are also coming out and concerns people have with variants. So yes, we are committed certainly to do everything we can, investment being a big part of that, expertise being brought to bear, and we hope that we'll meet our goals as we are doing this year.
Noubar, on the point of variants, and going back to what you said earlier about potential booster shots, trials you have to have the vaccine address different variants, does that mean that the shots you're rolling out to COVAX in 2022 are going to look different than the shots that are currently going into the arms of people today?
we will work with our COVAX partners to ensure that we have the most effective vaccines for the conditions that we need to go after. So that is indeed an issue that's going to require some level of forecasting depending on where we are. But what the overall structure certainly has a supply number in mind. Exactly what that consists of, whether it's primary vaccination or it's a boost, as well as whether it relates to variants, that has to be worked out, by the way, with COVAX as with everywhere else.
How far out does your production planning go, Nubar? Do you have plans going out for investment in production in 23, in 24, in 25?
Certainly, we're looking into 23 as we speak. We have said publicly that based on the best available information and our own work, we believe that this virus may well end up taking on an endemic character in the sense that there may be enough variants that we start seeing some form of it in various kind of seasonal fluctuations. So, it's not a sure thing, but it may well settle into a behavior that's similar to seasonal flu. We don't know that for sure yet, but we need to be prepared. One thing we've learned from this pandemic is that we can't hope for best case situation, prepare the least for that case, and then find out that it's not that. And so we need to do the opposite. So I think, yes, we are looking at 2023, but indeed, if we can get up to 3 billion doses, and if we can get even lower amounts per dose to show the same effectiveness, that will start putting a pretty significant dent on the global demand alongside our colleagues in the industry who are also using the mRNA technology to increase supply yet more.
With hindsight, Nubar, what should we have done differently with COVAX?
Well, look, COVAX has been stood up under an emergency situation and has faced a very challenging situation because on the one hand, they needed to secure support from countries and other institutions, even while trying to cut deals with vaccine manufacturers, which, a mere 3-6 months ago, the picture looked different as to which vaccines to source. So they did, I'm sure, the best that they could. And what they're finding is that the situation is shifting. And we're just pleased, although it's been many, many months in the making, that we're able to reach this milestone. And I look, being in the trenches in some level, Moderna as a company for so many months and watching our colleagues at OWS in the US, the NIH and others as well in the trenches, I have sympathy for others in the trenches that are likewise trying to figure out what's the best that can be done. So I just want to encourage them to keep going.
When do you think the world, and I know this is a big question, will actually reach herd immunity? And do we need to vaccinate children to reach that point?
Again, there's a bit of speculation involved in that, but I would say given the seriousness of the disease, vaccinating children seems like the better approach than not, because one of the things that nobody is factoring in is what the downstream health consequences of this disease are post-infection. The notion that children don't get a hard version of this is one thing. The notion that that won't have later stage effects, I think it's just an unknown. So herd immunity is something that I think will only be judged in hindsight. When we see the burden alleviate, then we're going to say, oh, in hindsight, we reached herd immunity. People are talking about it as though it's a knowable thing. I don't believe it is. I certainly think we should get as many people vaccinated as quickly as we can. And of course, throughout the world, because otherwise we're just not going to be able to contain the virus as we're seeing today in India and elsewhere.
Nubar, thank you so much. Nubar Afeyan, their co-founder and chairman at Moderna, talking about COVAX. Now, coming up in the next hour, Dr. Amish Adalja. He's Johns Hopkins Center for Health Security Senior Scholar. That's at 6:30 a.m. in New York, 11:30 a.m. in London. And this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
There's nothing new in crypto, so volatilities are everywhere. And actually, Bitcoin, Bitcoin's probably less volatile than similar-sized assets like Apple stock or even Tesla stock.
Well, that was the chief executive of Binance talking crypto yesterday on Early Edition. It was a great interview. Thanks to Matt and Kaylee. Now, what else are we watching? A lot going on, Matt.
Yeah, I'm watching Ether. I mean, Kaylee highlighted earlier the rise that we've seen. 1,500% in the last 12 months. It's up to, today I think it hit 34.55. And a lot of investors are looking at Ether at this level and saying, it seems expensive. On the other hand, we thought Bitcoin was expensive at 34.55. And that FOMO that's hit them in the Bitcoin run, I think, is pushing them into Ether. We can see the Ether-Bitcoin ratio climbing to its highest level in almost 3 years. I will tell our listeners on London DAB Digital Radio, first of all, I applaud you for listening to Bloomberg on radio. And the only thing you're missing out on is this chart. It's 88.19 in the terminal, and it just shows the resurgence of Ether against Bitcoin.
Still has a long way to go to catch up entirely to Bitcoin, though, Matt. Bitcoin's value over $1 trillion. Sure. I am watching trade balance data here in the U.S. at 8:30 a.m. Eastern time. We could be set for yet another record deficit. Economists estimating a deficit of $74.3 billion, Francine.
Yeah, I'm looking at the G7 in London, and I'm also looking at how Europe deals with China. Now, plenty more coming up. We speak with Ian Shepherdson on Bloomberg Surveillance. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
pretty simple to recognize that we're in the midst of a boom here in the U.S.
Because there's so much anticipation of this moment that we're fully reopening the economy. So I think there is vulnerability.
We're potentially going to see faster prices, both in consumer prices and wages.
The question is, how long is transitory? Is it a couple of months? Is it a year or 18 months? But it's certainly not long term.
Until the tax changes happen, you ignore them, but the reality is the market's not ignoring it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures slightly negative, down around about 0.1% this morning. Tom, I'm not even going to pretend that there's a lot to get excited about this Tuesday morning. It's a quiet start to the price action.
I think it's sort of nuanced here. You know, we're looking towards Friday. Let's get it out front. I've been watching ECO go. John, I'm sorry, we're ready to click 1 million on the survey on non-farm payrolls. 995,000 gets my attention.
Well, I will say gets my attention is the negative skew to price action that we've seen in response to data, in response to earnings over the last several weeks. And we saw that again with the ISM. If you don't beat, you will get hammered. And we saw that with earnings, and then yesterday we saw it with the data. So if you do beat, upside surprises don't really get massive rewards. If you miss, then you start to see things move. And it's the misses that seem to get more traction than the beats right now. And that's true of the earnings, it's true of the data too.
Absolutely. And what's so important here on Nuance Tuesday is you see the yield structure of Europe ever modestly pull away from the yield structure of America, a greater negative real yield in the United States. And John, you mentioned this morning, Germany comes up.
The nominal yield approaching zero maybe, Lisa, and that's got a lot of people's attention, laser focused on what's happening in Germany. I believe the low of the year was about negative 60 basis points at the start of 2021, and we're slowly inching back towards zero, negative about 20 basis points at the moment.
Can I just take a moment to stop? Nuance Tuesday is the new there's nothing going on. Basically,
well,
that's going to be...
say when things are quiet, Lisa, you just say they are nuanced instead of saying they are boring.
This will be a nuanced show.
Okay?
I do think that it's going to be really interesting to see where yields break here, because right now there seems to be a consensus, a stability in yields that's underpinning the risk on move. And I think about that both when it comes to equities. And yes, there has been sort of a pause here in the rally, but you're not seeing that in credit with some of the spreads, the extra yield that investors earn over benchmark rates for high yield debt shrinking to the lowest since 2007. The risk premium absolutely collapsing because it's very much risk on.
Where are we now? 285? 280 on spreads in America?
Yes, 286 actually.
Tighter.
Wow.
Unreal.
Yeah,
isn't it?
It's I mean, honestly, again, default risk is not on the table. The idea here that people are not worried about default risk, and frankly, they're not worried about that cushion being too small to absorb higher yields ahead.
Lisa, don't you think that people appreciate the honesty sometimes? Just tell them up front. Just tell the audience it's a quiet start.
This is going to be...
Take it a little bit slower this morning as you prepare to get ready for work. It's okay. Futures look like this on the S&P 500. I'll whip through the price action of the equity market on the S&P. 41.82, another upgrade today, this time from RBC, Laurie Cavacina, 43.25 from 4,100 on the S&P. We come at about 0.1% on the S&P 500. Euro dollar clinging to 120. A very small break of that a little bit earlier on in the session for the first time since April 22nd. We had a break of 160 to the downside on 10s yesterday. We're back through that level now, Lisa, up 2 basis points. Your yield on a 10-year maturity in America, 1.62%.
I'm shocked by actually how stable yields have been based on some of the expectations for inflation and the strength that we're seeing in the underlying market. I am actually interested in the data that we're going to be getting out today. So I am watching this. 8:30 a.m. We're going to be getting the U.S. March trade deficit. I'm just going to keep talking, Tom. There is an expectation that it will go even deeper negative, basically another all-time record high for the trade deficit in the United States. The interesting aspect of this is the underlying debate that perhaps U.S. money into household paychecks, into household bank accounts, has funneled into China, has funneled into Thailand, has funneled into South Korea, because this is where the production is happening and we're importing record amounts relative to what we're exporting. Then 10 a.m. U.S. March factory orders and durable goods orders. Again, the demand supply, oh my God, Tom, really? This is nuanced, I will tell you that. The supply-demand dynamic that we're experiencing right now is limited by some of the chip shortages, and we saw that very much in the ISM data yesterday, highlighting the record long wait times in order to get goods, some of these incredible disruptions. How much do we see factory orders surging as people try to get ahead of expected delays going forward? And today, the G7 foreign ministers are meeting yet again in London. I'm looking to see what kind of agreement there is on travel. How much are people going to try to go to vaccination passports or some way to open the transatlantic corridor, John?
I thought that was excellent. Thank you. Good. Lisa, thank you very much. I really did think that was excellent. One serious story we need to touch on today. Reaching herd immunity is unlikely in the US, experts now believe. That was in the New York Times in the past 24 hours, Tom. It has got a ton of attention because the average vaccination in America, in our Bloomberg vaccine tracker now, 2.29 million doses per day. We have dropped off by almost 1 million.
But we're
in the
still
last month
doing
or
it
so.
every day. I get it, John. And, you know, to be honest, most of the experts I've talked to have never said we're going to get to herd immunity. It's something the media fell in love with. What I would suggest, John, is far more important is this Pfizer story from the New York Times that they may migrate the age from 16 down to the vicinity of 12 years old.
Yep.
To me, that's a really interesting story.
We might get a little bit more news on that a little bit later. Looking forward to catching up with the Johns Hopkins team a little bit later this hour, actually. Joining us now is Ian Shepherdson, Pantheon Macroeconomics Chief Economist. Ian, are you back in the office, sir? Back in the office?
I am back in the office. Look, I don't have the dangly white earrings today because I'm actually on a proper camera with a proper earpiece. It's
Welcome back. Slowly getting back to normal, Ian. In your research, I just picked out one line. The survey points to core PCE inflation north of 2.25%. That would test the Fed's resolve. Would it, Ian?
2 3/4 actually, John. 2 3/4. I don't know whether that's my misprint. I hope not. Anyway, 2 3/4 I think would test the Fed's resolve. They've told us 1,000 times that they want inflation to go above the target. After so many years when it was below the target is 2. I think they'd be quite happy to see it drifting up to 2.5. But 2 3/4, you know, you're only a little slip away from 3. And I don't think they want it at 3 unless they're completely convinced it would come back down again. And the problem with the surveys that we're all looking at now, like this ISM and the Small Business Survey and every regional PMI, they've all got these price numbers shooting to the moon. None of them are saying inflation is going to go up and come back down again. They're all just saying it's just going to go up. Now, they don't look very far ahead. And it's entirely possible that really all they're saying is there's going to be a big margin spike when the economy reopens. Don't worry about it. That's certainly the Fed view. But it's not guaranteed to be right. And that's why markets are getting a little bit twitchy because they're saying, okay, Fed, you might be dead right about this, but we have to at least consider the possibility that actually maybe there's going to be something a bit more deeply embedded that's going to persist and force you maybe to start raising rates a bit earlier than you think. That's where the debate is.
If we embed an inflation expectation as part of that bargain, that we also embed a better economic growth?
Yeah, I mean, it's two sides of the same coin, really. You know, the idea that as things get better and the labor market tightens and all these millions of people who've lost their jobs come back into work, you know, this is a good thing. I mean, we want this to happen, but already, even before we get that big rehiring, a lot of businesses are complaining that they can't find the people that they need. So the danger is...
Hello, traders again. It's time to play stop on profit for Japanese yen, and I'm going to play stop on profit right to 109.410. Okay, just right here. It will give us, as you can see, 5 pips. Well, it's because Japanese yen 50 pips, yeah? But it will give us 500 pounds in profit. So if you decided to follow trade from the beginning a few hours ago, it's time to play stop on profit, so you will collect your profit if the price will change direction. Okay? Stay safe, and I'll speak to you later.
The fiscal and monetary policy, the Fed's still buying nearly $1 trillion of assets per year, so maybe this time we should be a bit more worried about these rising expectations as we get into the second half of the year and into next year.
What's the tipping point at which we have to worry about inflation? What kind of rate is bad versus good inflation?
Now, that's a good question because it's really all about the context. So, you know, you can have a 2.5% core PCE inflation rate, which is fine because it's steady or it may be starting to go back down again. The Fed wouldn't worry about that. But what if it's 2.5% and rising steadily? So, you know, in a year's time, it might be 3. Now, that would be a little bit more disconcerting to the Fed. But then there's a third scenario where it reaches 2.5, but it's just shooting upwards. So the wrong end of the hockey stick. Now, then you've got the same rate, the 2.5 on any given day, but it's a trajectory and it's a context, and it's where it might go afterwards that's going to exercise the Fed. And that's why this expectation story is so important, because if you hit 2.5 and it's rising, and people expect it to keep rising, and markets expect it to keep rising, the Fed will have to respond to that in a very different way than if it just steadied at 2.5 and everybody thought, okay, no big deal. So context is everything. It's about trajectory, and it's about speed, and it's about how the market feeds its view back to the Fed and how the Fed then chooses to respond. Now, this isn't going to happen very soon, but I think it's a real live issue for markets as we get into the fall.
Ian, this is where 90% of the audience in America turns the volume down, just for you and I, and maybe Tom too. Lisa's going to hate us for it. Newcastle, 6-point buffer from you in relegation, 4 games to play. Do you survive? That has got to be the most important question in Newcastle right now.
Oh, it is. Well, I'm sitting in the middle of the town right now, and if I did a vox pop on the street right now, well, there's no one out because it's raining, obviously, but I think most people would say we'll probably survive, which I'm kind of upset about, because I was hoping that if we got relegated, then there'd be a better chance of the club being sold. But, you know, nobody wants to play in the lower league, so I guess I have to grit my teeth and say, okay, we survived. It's a good thing.
Wonderful.
But really, it's just 10 years of misery.
Ian, just selling it to be a Newcastle fan. Ian Shepherdson there of Pantheon Macroeconomics. Thank you, sir. Thank you very much. Ian lent there on the data that we've seen in the last 24 hours, some of the delays, some of the cost pressure. This was basically the takeaway from the ISM number we had in America yesterday, the PMI we had in America yesterday on manufacturing, shortages of basic resources, rising commodity prices, absenteeism, difficulty hiring, all of that leading to short-term shutdowns. This is because there is so much demand. Let's be clear about that, Tom.
Yeah, this is a terrible
These things
thing.
are happening because there is so much demand.
Didn't we hope for this like 6 months ago or 8 months ago? That's what I don't get. John, I see the negative real yield. We went from negative 0.79 down to negative 0.81. What I love here is it's not Nuance Tuesday. We're heading up on Snooze Fest Wednesday, which gets us out to Jobs Day.
Sell it.
And
Sell
I'm sorry, I'm selling it right now, folks. This Jobs Day is absolutely historic. Tom Porcelli was on fire yesterday.
What did he say, Tom?
He said, this is the real deal. I'm sorry, it's going to be a million here, a million there, a million, you know, whatever the number is, it doesn't matter.
Wait, so what do we have on Thursday? We've got Nuance Tuesday, Snooze Fest Wednesday. What's Thursday?
Tots Thursday.
Tots Thursday. Get claims on Thursday. Then we get the ISM services numbers tomorrow.
There's so much good stuff coming. Stay with us for good conversation.
There we go. At least you know when I say it's an important week, you'll believe me. I hope. Up 2 basis points on a 10-year, 161.72. Euro dollar 120. Negative 0.5%. Dollar strength this morning.
Well, not
S&P
now.
500 41.83 and down 3 on the day, off by about 0.1%. From New York City, this is Bloomberg.
With the first word news, I'm Rishka Gupta. In India, Prime Minister Narendra Modi is fighting pressure to lock down the country to control the world's worst coronavirus outbreak. Today, India reported more than 357,000 new infections to cross the 20 million case level. Still, some experts say that a lockdown would be disastrous for the poor. Modi's government has left it up to the states to decide on local lockdowns. In Mexico City, a raised subway track collapsed, plunging train cars with passengers aboard to the ground. At least 20 people were killed and about 70 others injured. The accident is blamed on a broken beam. The subway line that collapsed opened in 2012. The project suffered from design problems during construction. President Biden has now increased the number of refugees who can enter the U.S. through September to more than 62,000. That comes after allies blasted his earlier abandonment of that goal. Last month, the president issued an order retaining Donald Trump's limit of 15,000 refugees. And a fortune valued at $146 billion is at stake in the divorce of Bill and Melinda Gates. The couple announced that they are splitting after 27 years of marriage. They made no hint of their financial plans, though they emphasized that they will cooperate on continuing their philanthropic operations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Why did you decide to become Secretary of Commerce? Because in Rhode Island, you're the 800-pound gorilla because you're the governor.
Because I wanted to be on the team that helps America build back.
How do you start your morning?
Guess who won the fight in a commercial break? This black eye you've got right now looks so authentic.
You let him get in a good punch.
Wake up with Bloomberg Surveillance, weekdays on Bloomberg Television.
I'm not anti-corporate, but it's about time they start paying their fair share. It's about making a choice. You know, we have out there this year, you have 50 corporations making $40 billion that didn't pay a single penny in taxes. Not a single penny. I don't want to punish anybody, but everybody should chip in. Everybody should pay something along the road here.
The President of the United States there on corporate taxes from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action this Tuesday morning, Nuance Tuesday, in the words of Tom Keene. Equity futures down 3. We're off by almost 0.1%, 41.82 on the S&P 500. Euro dollar just about holding on to 120. The euro had a break of that level a couple of hours ago for the first time since late April. In the bond market, yields were lower yesterday, a break of 160 off the back of a downside surprise from the ISM and I believe the PMI in America as well. A little bit of a lift this morning. Yields higher by 2 basis points to 160, 172. And just to round things out, Tom, WTI 65 handle. There we go. Up by 1.74%, $65 and about 60 cents.
Yeah, churn in the market as well. There is no churn in Washington. There is really front and center focus, and the focus was made ever more so by the retirement of a gentle lady from the 17th Congressional District of Illinois. We talked about that yesterday, and a stunning result out of the Texas 6th Congressional District. This is south of Dallas, south of Fort Worth, and it's real simple. The Republicans won, the Democrats lost. Martin Schenker joins us, Bloomberg News editor-at-large in charge of all nuance here at Bloomberg Surveillance. Marty, Greg Vallier says there's no nuance. He says we're heading for gridlock in 2022. What does that mean for President Biden in 2021?
Well, that means he's going to have to try and figure out how he forms a coalition of his base to get his agenda through. We have a story this morning that says this could drag out well into next year.
That's to the benefit of the Republicans, isn't it? I mean, this is a really important story, this timeline, this calendar. And, you know, for the joke this morning, there's no nuance here for the Democrats. Labor Day is not the end of the year.
That's correct. And so, yeah, the timeline is very delicate. And the Republicans, however, do have a challenge in getting a common message across on how you oppose some of the things that polling shows the American people support.
Marty, on Nuance Tuesday, I want to ask about the center of gravity in Washington, D.C. Is the momentum going toward pushing through this stimulus effort, the Biden plan, or is it on the foreign policy level, or has it gotten to this just sort of general morass of gridlock, which is basically the way Washington is?
Yeah, the interesting thing, Lisa, is that the volume has been turned quite a bit down from where it was 4 years ago. So it doesn't seem as stark. But on the ground, the reality is there is very little appetite among the Republicans to go along with anything Joe Biden has proposed. So this could drag out months and into, as Tom points out, the midterm elections.
Okay, so in other words, there might not be any stimulus passed before next year. Is that what you're saying, that seems like a possible and likely outcome?
It's a possibility. I personally think that the one part that could get through with Republican support is a much scaled down infrastructure bill that includes roads, bridges, tunnels, highways. And there seems to be an appetite among Republicans to get that done.
I mean, there's 8 ways to go here, and the other side of it is Mitt Romney booted a convention and Liz Cheney fighting for political leadership life here right now. And again, it goes back to the color of the middle, the Democrat middle, the Republican middle. For our global audience, identify the middle Republicans out there. How lonely is Senator Romney of Utah?
They're pretty lonely. You know, and it's going to be very interesting. Tomorrow is a decision by the Facebook advisory board on whether to allow Donald Trump back on Facebook.
Why shouldn't he become? We're going to stop the show here. This is really, really important right now. Martin Schenker has been doing this for about 70 years. I don't know. He was back with Hearst. He's in the movie Mank from the 1930s with Charles Dance. Marty, come on. Why shouldn't a citizen be on Facebook?
It depends. Well, the advisory panel is going to make that call. Look, he was removed because of concerns about inciting the Capitol insurrection.
Okay, that's fair. Yeah.
And so now the question is, as a private citizen and a former president, does he get to go back on and actually establish a social platform that gave him voice throughout his 4 years? It's a pretty important decision.
All right, Marty, on this nuanced Tuesday, I'm not going to add decades to your tenure on this earth. I will say, though, Marty, that going forward, there is also a question about the U.S. relationship with China. And not to go totally off in left field here, but the G7 meetings really has highlighted this, and that Biden seems to be getting his way and getting some sort of coalition within the European Union, or at least aligning some of the goals a little more tightly when it comes to countering China. Can you talk about where that's heading, how significant this progress is?
Well, I think it's pretty significant that the Europeans which spent some time forging alliances with China during the Trump years, have now pivoted and are working together with Biden to crack down on China by limiting investment in European companies and the like. And it suggests that China is going to have a much harder time negotiating its way through its various global initiatives on climate, on Belt and Road, and other things. So it's going to be more challenging for China for sure.
Marty, how the United States builds a bridge with America is one thing. I just wonder, with Europe is one thing rather, I just wonder how they actually get a foothold in the region, in Asia again, in a much bigger way. That was a focus of the former Obama administration. Will there be a shifting of emphasis there too?
Well, they tried to do that at the beginning of the Biden administration with, going out with India and their other allies in Asia, but it's still unclear whether or not they're going to forge some sort of formal Asian alliance that the Obama people forged in late in their administration. So it's unclear how the U.S. is going to organize that effort.
That strategy, we need to see what it is. Marty, it's great to catch up as always. Marty Schenker there, Bloomberg editor at large. I believe foreign ministers meeting in London today, Tom. No doubt this will be a big topic.
Yeah, it will. I mean, they're going to meet in London. The travel thing, as Lisa mentioned, is really, really front and center. But, sort of, John, it's almost a path back to normality. It's these kind of meetings take on a real symbolism of trying to open up.
Tom, I agree. Multilateralism is back, but we can't have the same old results. That's what's got to change.
Okay, I mean, it's going to change. What do you think the piano bar is going to do in Davos? I mean, are we going to get back to multilateralism next January?
Maybe, but let's be clear about this. There was severe voter pushback to the approach of yesteryear, Tom, because it generated the same results year after year, decade after decade. I don't disagree with that.
Yeah.
So something's got to change. You can go back to multilateralism, and maybe for a lot of people, that's a good thing. Not here to offer my opinion on that. Just looking at things, just some very, very simple analysis, the end result has to change. The end result has to change.
In all the major cities and the people watching this worldwide, the multilateralism between the employer and employee and work from home is really going to be front and center just in the next 60 days.
What point are you trying to make there, Tom?
I'm not. I just think there's a lot of societal debates here We're trying to get through Nuance Tuesday here, and there's a lot of societal debates.
He's trying to get someone back to work.
Yeah.
Is that what that was?
I talked to Chart Banner yesterday.
Who are you trying to get back to work?
That's what I'm asking, Lisa.
Chart Banner's on some beach somewhere.
It's like some veiled insult
coming
in to a member of staff. I just can't figure it out.
I was on my knees.
Can we wish Lisa Abramovich congratulations? Fully vaccinated.
Fully
with that
vaccinated.
Nice 2-week buffer. Congratulations,
That
Lisa.
bill's vaccinated.
I appreciate it.
This is Bloomberg.
This is basically going to kick off the whole week.
From bank earnings.
Bank earnings really have to be front and center.
To tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
From New York City for our audience worldwide, this is Bloomberg Surveillance, and here's the price action. This Tuesday morning, equity futures 41.81 on the S&P 500, down around about 4 points and off by 0.1%. We caught up with Jonathan Golub of Credit Suisse recently, the biggest bull on the street at 4,600. Laurie Calvasina of RBC also upgrading recently, just in the last 24 hours.
Yeah.
Looking for 43.25 from 4,100.
John, stop
previously.
there. That's really important. Tell us why Laurie Calvasina is important.
The adjustment, Tom, is important. Lori Calvasina is important because she's nailed this market for so long.
Exactly.
The trajectory starts to shift, though. A lot of people are stuck with their year-end price targets until the last couple of days. I think Lori Calvasina is important because she's one of my favourite guests, but that's my personal opinion.
I was going to say.
That doesn't matter so much. You know, I'm just going to throw that
She's
out there
awesome.
anyway.
She
Lisa, I
nailed
agree.
the small and mid-cap move.
Correct, Tom. So did Jill Kerry-Hall over at Bank of America too. For whatever that's worth this morning.
They were both nuanced.
I'm going to carry on. Russell futures are off by about a tenth of 1% too. NASDAQ futures off by a third of 1%. We're going to talk about this negative skew to price action that we've seen in this market, just in response to the earnings, in response to the data in just a moment. But let's switch up the board and get to the bond market. And I'll keep this short, snappy. 2s, 10s, 30s. Your yield on a 10-year, 162. Your 30-year, 229.60. Yield's coming up a couple of basis points. We had a break at 160 yesterday on a 10-year. Now we're back through that level this morning. Speaking of a break, switch up the board and get to euro-dollar. Euro-dollar, a break of 120. You can just about see it a couple of hours ago. A break back through it again at 120.13. Tom, really interested to see this play out. We're down about 0.4% on euro-dollar. The direction of travel is a better Europe. Reopening maybe, more vaccinations, but the euro, this morning at least, just clinging on to that 120 handle in today's price action.
Yeah, very good, John. I want to go also on that to the idiosyncratic. Turkish lira bears watching here. It's something way off the radar right now. But dollar euro at an 8.34. It's not a nuanced lira. It's a joke there, folks. It's not funny for Mr. Erdogan. Weaker Turkish lira is something to keep your eye on. And also, I'd note CVS moments ago, a red sticky across the Bloomberg terminal. CVS doing better than good with a little bit of a lift there in the view forward. And, of course, with their huge drugstore combine across America, always important. Right now, this is a really, really important interview for those of you worried about the stock market. Andrew Slemon is with Morgan Stanley, a senior portfolio manager, among other duties. Andrew, I want to talk about the nuance here. As we went to air, you were talking about not raging, but being a raving bull. You're not a raving bull, but you're in the market. How can you do that?
Well, I mean, all I'm trying to say is, look, I mean, let's keep it simple here. Stocks are the present value of future expectations. And what I see is companies are blowing out expectations. So I don't see how you can't take a step back and say, wow, you know, something's going on. Companies are saying things are better than what Wall Street expects. And I think you have to respect that in what the market's saying.
The charm of your research note is you've got the usual blather, and then you've got a killer paragraph of data where you go, oh, he and Morgan Stanley did your homework. You have the street with an 11% miscalculation on earnings. They missed it by 11%. Put that in scope and scale. What does it mean forward?
Well, you know, that's why I have a hard time someone telling me, well, you know, we started the year with $167 of earnings. That was what Wall Street expected. We're now at 185. I guess I'm just not smart enough to listen to someone who says, that's it, it's not going up. I mean, I have a hard time believing that. And the market is only up by the magnitude of that earnings whiff. So I don't think you can say the market's gotten frothier than it was earlier in the year. No, the market's just repriced based on that miss. And if we continue to move higher, which I think it's always very dangerous to draw the kind of the line in the sand and say, this is it, then I think the market will continue to push higher. The other thing that I think is really important here is the Dow Jones Industrial Transport, the old index that tells you how the market, it's kind of 13 weeks in a row. You got to respect that. Something is going on here that I think Wall Street is not optimistic enough about what companies are saying.
Andrew, that's healthy though, isn't it? It's healthy. We're not getting carried away with this at the moment. We're looking at prices almost exclusively at the moment. We're focused on execution risk.